morning. I'm Julie Hyman alongside Brad Smith. This is Yahoo Finance Live. Let's get right to the three things you need to know to start off your morning. First thing you need to know, the worst may be behind for Micron. The memory chip maker posted its biggest quarterly loss on record amid a dramatic inventory correction. But Micron's forecast left Wall Street feeling more optimistic. CEO Sanjay Mehrotra said he expects, quote, gradual improvements to the industry's supply-demand balance. And analysts are banking on that glimmer of hope, with JP Morgan raising its price target and Barclays giving it a new buy rating. Second thing you need to know, two big CEO shakeups that we're keeping an eye on this morning. UBS is bringing back its former chief, Sergio Ermotti. That starts April 5th to navigate the bank through its acquisition of Credit Suisse. Ermotti was UBS CEO from 2011 to 2020. He's credited with overhauling it after the financial crisis. And the other shakeup we're watching is Macy's. The department store chain announced its CEO, Jeff Gennette, will retire early next year after 40 years at the company. Bloomingdale's CEO, Tony Spring, is going to take his place. And third thing you need to know, a sense of stability for now has seemingly returned to markets, with banking fears taking a back seat. The focus shifting to the path of monetary policy ahead of the Fed's interest rate decision in May. Investors are increasingly expecting another quarter-point hike. There's no shortage of catalysts in the coming days, with the key inflation reading on the docket and Fed speak from Susan Collins and Thomas Barkin ahead of the weekend.
Well, Micron posted its biggest quarterly loss on record as a weak market for PCs and smartphones weighs on the company's financials. But Wall Street is optimistic on the memory chip maker after the company signaled that a turnaround is ahead. A few things that they did point to as you're seeing shares move higher here pre-market. Beyond the downturn, they anticipate a return to normalized growth and profitability in line with some of their long-term financial models. And if you're wondering how long-term that is, they believe that the memory and storage TAM will grow to a near record in calendar 2025, continue to outpace the growth of the broader semiconductor industry thereafter.
Yeah, memory chip makers like Micron are perhaps more exposed than any to these types of inventory cycles and ups and downs. Memory chips are seen as a commodity. There aren't that many companies that make them. It's Micron, it's SK Hynix of South Korea, and Samsung, which also does a lot of other stuff besides. And so pretty small number of producers, big market obviously, but again, one that is commoditized. And the company's been trying to sort of smooth out some of the bumps that it sees periodically, not just in this current period. So Micron, some of the measures that it's taking here, in addition to trying to sort of smooth that out, it had announced a 10% workforce reduction. That is now going to 15%. And it's also cutting its spending on new plants and equipment by 40%. So that spending will look like $7 billion this year. So it's pretty aggressively trying to go after these cost reductions like so many other companies in tech right now.
Yeah, and we were seeing on what they mentioned in terms of what the opportunity for growth or normalization looks like in the future. A lot of the other semiconductor names, or names that really not just dabble in the same space, but are baking their entire growth models on the entire landscape for the normalized growth and profitability that Micron was talking about. Those companies moving higher in concert pre-market here. And I was looking through my notes just to find this one particular, because it's going to come down to capacity and how much they're continuing to bring online even more of the production here. They said that they're making good progress towards some of their gamma nodes in 2025. And then for the super nerdy out there, if you were focusing on this as I was, the 1 alpha and 1 beta nodes, they're expecting that to provide them with the competitive performance, power cost, density improvements that they're talking about as well. And so all of this considered in this broader DRAM market, I think for Micron, I think they gave them at least, or gave the street at least enough in the future to look forward to say we're on track to hit a lot of these targets net.
Right, exactly. There are some skeptics here. Morgan Stanley's got an underweight. I think we saw there are 2 sell equivalent ratings on the stock. Morgan Stanley is one of them, and the analysts there are saying that they admire the company's execution in a tough environment, and that's what they said in a note. But we see these challenging trough conditions weighing on the stock materially, even in the next upturn. So still some challenges ahead according to them, but broadly, it looks like the street is reading this as okay, things are not going to continue to get
Right.
worse necessarily from here.
Don't have to write down inventory as much anymore.
Yes, we'll see. We'll see what ends up happening. All right, let's move on to thing number 2. In a surprising move, UBS is bringing back former CEO Sergio Armati to helm the bank's massive takeover of Credit Suisse. Shares are rising about 4% in pre-market on news of the new leadership. This as Macy's announced current CEO Jeff Gennett's going to retire early next year. He's been there for 4 decades at the department store chain. Genette, who steered the company through major digital growth in the COVID-19 pandemic, will be replaced by Macy's own Bloomingdale's CEO Tony Spring, who, by the way, has also been there for a really long time. I think he joined in 1987. But let's talk about UBS first. This is, I think, definitely the bigger of these two, right? Sergio Armati, who was there and really took the bank out of the financial crisis, shrank down its investment bank, made a lot of changes that the street saw as positive for the company. He also, by the way, critically, is a Swiss native. Yes, he's got the Italian last name. He grew up in a town that was Italian Swiss, right? But Ralph Hammers, I believe, is Dutch, and there had been for the first time 2 non-Swiss in the chairman and CEO roles at UBS, and so now going back to a Swiss CEO.
Interesting. Well, great thing that for Armati that UniCredit job never worked out, because ultimately he didn't get that one. However, stepped into the role at UBS. That was back in 2011, as you mentioned. And what was taking place at UBS at that time? Basically, he walked right into a trading scandal north of $2 billion that he had to course correct for, not just in the company's kind of brand and name and reputation, but also ensuring that they were able to get through a new type of period that every bank was going to be under high scrutiny for what had just happened with the GFC and the financial crisis and the roles that banks had within that. However, wealth of experience within investment banking, of course, wealth management as well. So really looked at as kind of this figure who is good at charting turnarounds for companies and specifically within the financial services industry.
Yeah, and now, of course, the chairman, Colm Kelleher, also helped sort of rejigger Morgan Stanley when he was there. He was there for 30 years, in fact. So the other thing I have to wonder is with bringing Armati back, does that also help with retention of talent, not just at UBS, but at Credit Suisse as the bank takes it over? There's been some reports this week about executives from UBS flying around the world to try to retain key Credit Suisse talent who they don't want walking out the door amidst this takeover. So you wonder how much Armati is going to be doing some of the same job even as he tries to rejigger. And there's one more job or one more pickle, one more challenge, one more wrinkle in UBS's acquisition of Credit Suisse. There's just a report out from a Senate investigation that says that Credit Suisse is complicit in tax evasion by ultra-wealthy Americans. This is something that's been out there, and it's sort of, when we were talking about Credit Suisse's troubles and looking at the timeline and seeing sort of all the various scandals at the bank, this is something that was periodically popping up. And so, again, this is something that the Senate has released today that now Armati's, I guess, going to have to deal with.
Yeah, even more coming from Capitol Hill with regard to the broader banking turmoil, of course, today as well, and we'll be tracking that. But then additionally, you think about this other role in Macy's CEO that I just want to circle back to as well very, very briefly here. Because at the end of the day, I think for Macy's and how they've tried to chart their own turnaround story, this is a brand that's had to invest so much and I would say was kind of late to the game within their e-commerce strategy, or it was just far too cluttered. There were so many SKUs on the website that easily a customer could get inundated. And so now looking at how they've been able to move forward the digital strategy, have that meld better with this broader omni-channel approach, and then even in the items that they've got in store, making that more kind of fashion conscious, even as you'd seen the growth of some of these homegrown brands, especially within the department store, like Macy's, like you can go down the line, Macy's, all of their subsidiaries, Nordstrom, and so forth. But within all of that, I think they've been able to show now that there is more of an uptick, or at least a take on of some of that inventory from the higher value consumer that's out there too, saying, okay, yeah, you got a Scotch and soda out there, great. You got some of the higher end brands that I'm looking for, but they have lost some partnerships as more direct to consumer strategies have emerged, like that of a Nike as well.
Right, and Macy's is still predicting its comps are going to fall 2 to 4% this year. So it doesn't seem as though there is a forced out situation here for Jeff Gennette, as far as I can tell. But it is a time when, yes, he has led Macy's through some tough times, but it's still not doing fantastically well. So this is the challenge that Tony Spring is now confronted with. Incidentally, as I was looking at this announcement here, noting that at all of the big department store chains, it's all dudes, which is kind of interesting. And it's not diverse dudes. So it's interesting. Although I should say Jeff Gennette is an out gay CEO, which is relatively rare still in corporate America and even in retail in particular. But it's just interesting that we're not seeing that diversity at the top of, especially since you typically hear retail CEOs talking about her as the customer.
Right.
They talk about this apocryphal her as the one that they are gearing towards. Anyway, it's just
it's a great point.
A side note that I noticed as we were talking about this.
Yes, and if the core consumer is, of course, a diverse basket of customers, at the end of the day, the executive team should probably reflect that as well.
Yeah, I mean, the board, I guess, is more diverse at Macy's, but
that's
anyway.
Right.
Just a side note.
Well, another story that we're tracking, a sense of stability, trying to return to markets here. Banking fears taking a backseat, at least for right now. Focus shifting to the path of monetary policy ahead of the Fed's rate decision in May. Joining us now, we've got Anastasia Amoroso, who is the iCapital Chief Investment Strategist. Anastasia, great to speak with you as always. I don't believe we've been able to get your broader perspective on what's played out and if we really are out of the woods yet, or at least if the market is signaling that we're kind of out of the woods, or just waiting for another shoe to drop on the other side.
Well, good to see you, Brad. And I do think that this sense of stability is actually justified, at least for the time being. I mean, we had three, I would call them pretty critical developments in the last several weeks. First of all, the reason why we've seen, this flight of deposits, one of the reasons is because people were shopping for better options where they can park their cash. And if you look at sort of what happened after the Fed meeting last week, I call it a de facto pause because they told us with a summary of economic projections that they may actually pause around 5.1% this year. And as a result of that, you've got the 2-year Treasury that moved down a lot from, at some point it was 5%, now it's just a little bit shy of 4%. So as a result, I think it sort of slows down this shopping for yield, appetite that we've had before. So that's one thing. The second thing is, we still don't have an explicit guarantee, but I think on deposits, on uninsured deposits, but I think we've heard more and more sort of a consensus emerge from policymakers that if warranted, there would be such a guarantee. And then the last thing, Brad, I think just the fact that we've had some positive resolution to, several bank wind downs, that also contributed to the positive sentiment there as well. So, you put that together, and I do think the sense of stability for now is justified. If you ask me, are the banks completely out of the woods? I would say no. There's commercial real estate issues. There's just the lower net interest margin issues, but that doesn't necessarily need to spell a broad crisis.
So, Anastasia, given all of that has brought stability to the markets, now what, right? Now where are you turning your attention for a potential next catalyst that is either going to unlock some gains here or send us back lower?
Yeah, I actually do think, Julie, that we are poised to hopefully unlock some gains in April. So I'm looking forward to that as a potential positive month. First of all, you've got seasonality on your side in April. Stocks tend to be up 76% of the time, using kind of a long history of data. And on average, they deliver more than 1% for the month of April. But, that stat aside, you can't just rely on that, of course. What I'm encouraged by is that we have significantly reset lower the positions across the board. You've got hedge funds that have reduced their exposure to equities. You've got mutual funds that did the same thing. And then you've got some of the systematic trading advisors also reduce their net equity positions to really the lowest level since 2020. So you take that and you say, well, we're right at this near-term technical level of 4,000. So if we just manage to have a little bit of positivity, a little bit of stability in the market, then we're going to be above that 4,000 level. And that is likely to cause some of these systematic investors to get back into the market. But because they're getting back from such a low positioning standpoint, their appetite to buy can actually be pretty significant. So I like that technical force that can, play to our advantage in April. And then, technicals do not work without the fundamentals. So on the fundamental side, maybe you have the Fed pause, maybe you have bank stability. But I actually also think the earnings season may be better than people expect. Because once again, the bar for this earnings season has been reset a lot lower, Julie. And then you look at the economy, and it is not done nearly as poorly as people feared. In fact, we're tracking 3% GDP growth for the first quarter. So I actually think that companies may benefit from this stronger than expected environment and deliver better earnings. So that could be your fundamental catalyst.
So are valuations then, are they acceptable? Are they attractive at this level? And especially in a sector like tech, where we've seen a massive pickup in recent weeks.
Yeah, I don't think valuations are extremely attractive, Brad, but I also don't think they're extremely stretched either and overvalued because, some people might argue, well, 16, 17 times, that's expensive when you think about the Fed, when you think about the economy slowing down. But if this economy for now managed to hang out around these levels, if we're not going to have an imminent recession, then we don't have to have a recessionary multiple of 13, 14 times. So to me, where we're trading today, whether it's on the S&P or the tech sector, is actually fair. And then technology itself, if you look at the Nasdaq, for example, the multiple was 35 times forward earnings about this time last year, and is now reset lower to 22, 23 times. So that's a massive reset. You've got semiconductors that have traded cheaper, and then you've got a huge multiple reset in software as well, from something like 20 times EV to next 12 months earnings to about 5.5. So that's pretty significant reset. And again, to your point about technology, in a sector that may actually be sort of defensive from the earnings perspective. It's not a cyclical sector, it's not energy, it's not financials, but it also something that has this secular tailwinds as well. So I think you put all that together and you don't get the excessively attractive multiples, but I don't think they're stretched either.
Yeah, maybe you get some opportunities at the very least. Anastasia, great to catch up with you as always. Anastasia Amoroso, iCapital Chief Investment Strategist. Appreciate it. Well, WeWork is doubling down on its space as a service business with occupancy rising 12% year over year. The company also announced a new series of agreements aiming to cut back on its debt by roughly $1.5 billion. WeWork CEO Sandeep Mathrani joined us now, and Yahoo Finance Executive Editor Brian Sozzi is sitting in as well. Sandeep, thank you for being here. So you recently did this big restructuring. Where does that position you now going into the next year, 2 years, 5 years?
First, thank you for having me. I really appreciate it. We did do a debt restructuring. One of the items that was hard on was our balance sheet. We needed to sort out to give us the runway. We have restructured the debt by extending it to 2027, reducing our debt on our balance sheet by $1.2 billion, and adding another $1 billion of liquidity. So we have now the runway we need to grow our business and go on the offense versus being on the defense. Our business is, all about flexibility on cost, time, and space. And in this post-pandemic world, all topside occupiers, small businesses, medium businesses, and enterprises are seeking a solution that's complete, that's holistic, that doesn't require any capital investment. So it almost feels as if this moment was created for WeWork as a provider of space. So I think we set up ourselves very well on a balance sheet perspective to get on the offense.
Sandeep, Brian here. Good to see you. And you do mention your shareholder letter out this morning that you do think this is WeWork's moment. To that end, where are you at pulling back on expenses, and when will you hit that adjusted operating profit mark?
So, we've been at adjusted EBITDA positive in December for the first time in the history of this company. We will be adjusted EBITDA positive throughout in 2023. So we've achieved, and revenue continues to climb in 2023. Revenue grew last year, as you know, almost $700 million, or almost 26%. Occupancy grew as well, about 17%. And so effectively, we continue to see revenue growth at a time where we're actually taking demand from traditional occupiers, right? So we control 1% of the market in New York City, and we took 18% of the demand. In London, we control 1.5%. We took 35% of the demand. What that is saying to you is that the occupiers are leaning towards flex space. And so to answer your question, Brian, on expenses, we've been very diligent over the last 3 years since I've been CEO to take out expenses, whether it be right-sizing the organization, streamlining the real estate portfolio, and making sure we're a well-oiled machine. We continue to streamline the company. I would say that it's a process that never actually ends, and it should never end. You should get more efficient over time. But I would say the bulk of the work has been accomplished. For example, we took SG&A, which we've talked about being at the almost $800 million at the end of last year. It's going to be in the low 600s this year. So we're taking cost out there. We streamlined our real estate portfolio. We continue to do that. The beauty of where we sit is we're a tenant. And when assets become obsolete, there's an oversupply in the market, we're able to adjust the supply and demand characteristic. We don't own the buildings. So we're not handicapped by mortgages. We're not handicapped by lenders, putting restraints on providing rent concessions and tenant allowances. We provide a turnkey solution. So occupiers are seeking certainty in this moment in time, and we're able to provide that certainty to them on an immediate basis.
Does the WeWork model right now, and especially in the profitability benchmarks that it's set for itself, does that bake in another kind of drastic shift, if there were to be one, on the definition of what the workplace is, given that the pandemic turned that on its head, essentially?
Well, in many ways, it's exactly where we are, right? So in an environment where people want to come in, they want to come in for a purpose. They want to come in for collaboration. They want to be able to take space that's required. They want to be able to have a cost per head that's more reasonable. Look, pre-pandemic, human resource departments could predict 10 years out what the growth of a company would be. And CFOs were okay with taking on real estate to accommodate growth for 10 years. Today, that's an unknown. And so we provide that perfect solution where you provide 12 to 24 months commitment, and you can grow with us. I'll give you an example of a company called Procore. Procore was a company that's a software company that does work in the construction field, and they took office with us in Tampa, and all through the pandemic they continued to grow, and they've continued to grow with us. Again, they took space as needed, and we managed their growth as it went on. You have companies that are going into new markets. Boston Consulting Group moved into Nashville. They opened an office at a WeWork. So again, since you don't know what the future is, even more so today, we become the choice, and we allow members to grow with us. Coinbase, took space with us in San Mateo. So these are all different types of clients that we have that are entering new markets or growing in existing markets, or they have a return to work policy starting in April or May, and for them, they need the space to house their employees today. So effectively, this is our moment. And to answer your question, if there is a hiccup of sorts, we don't know what that hiccup could be. But during a slowdown of an economy, flexibility becomes more the name of the game. I could very well see, and we're seeing it today, that clients would give up their large footprints and downsize And since they don't know how much to downsize, how the future is, they could very well come into a WeWork. And we've seen that with a large search client in California who moved their corporate headquarters into a WeWork. And so we've seen, fintech companies, who grew as small offices in Paris, a company called Quanto, and they now occupy an entire building with us. So, we're able, the most important thing you have to appreciate a CFO wants is the lowest cost per person, right. And we're able to provide that by providing, the real estate and also providing our digital products of all access and workplace management. So you can actually optimize the real estate needs and actually lower your real estate costs. So I think, the way we've created our holistic program, it seems to be what the future wants. And look, the largest companies as CBRE and JLL have said that the flex market will go from 2.5% to 15 to 20% by the end of the decade. And if that is to be the case, and we're seeing that in talking to our client base, then actually there will be a supply-demand imbalance, because today a very small percentage of commercial office is in the flex arena. And if you look at the international markets, look at London, Paris, Dublin, Milan, Southeast Asian markets, those markets are already in the 80+% occupancy for WeWork and have very healthy margins. And we've shown the margins in those businesses well over 30%. And so the US has lagged, and we know why, because the return to work policy has been slower and it's starting to change and evolve. And that should benefit from us.
Sandeep, before we let you go, you mentioned some tech names. About 25 to 30% of your tenants are in fact tech, Meta and Amazon. These companies are cost cutting. They're laying people off. What are you seeing from those tenants looking into the second quarter?
So, it's an irony, right? The irony is the headlines talk about the layoffs, but if you actually look at the pre-pandemic workforce of all these companies, and you look at the post-pandemic workforce of all these companies after the layoffs, there has been substantial growth. So the headlines talk about the layoffs. They don't talk about the growth from pre-pandemic to post-pandemic. And if they had to bring these people back into work during the time they were growing the employee base in the pandemic, they were not looking for real estate, obviously, because there was a work from home policy. And so now, as a lot of these companies are insisting people come back, whether it be 3 days a week or 4 days a week or a hybrid schedule, they are all reaching out to find space to accommodate their needs. So until we all figure out what the right return to work policy is, we're actually seeing demand across the board, whether it be tech companies, financial institutions, consulting companies, even pharmaceutical companies. And you never think of a pharmaceutical company as a tech platform. We recently leased an entire floor to Moderna in Seattle, and their rationale was that effectively we want to take advantage of the tech layoffs, and we want to make sure we can hire that talent in Seattle. So actually we think there's more emphasis on the return to work, which will take up space, versus the thesis that there are layoffs, because once again, they have more employees today than they did pre-pandemic.
Sandeep, thanks for being here. Good to catch up with you. Sandeep Matrani, alongside Yahoo Finance's Brian Sazi, talked to us this morning about WeWork.
Thank you so much for having me. Have a great day.
Thank you. We're just a couple minutes from the opening bell here on this Wednesday, and we've got some strength being seen in the futures here this morning. We were just talking to Anastasia Amoroso by Capital a few moments ago about the stability in the markets, but I guess this is more than stability. This is an actual day of gains thus far, Brad, that we are seeing for the futures.
Gains. She also said, though, that valuations at this level are not exactly attractive, but they're not terrible as well.
Not overvalued is what they're where they should be, kind of, is
Yes.
what she was saying. But of course, the dynamics can change on a dime, as we know.
Right.
We've got Fed speak coming, we've got PCE coming on Friday. So there are still some things that could rock the stable boat, if you will, that are coming up this week.
Right, and we're just a few weeks out from the next earnings season, even though we have some other
my
earnings
gosh.
that have trickled in. Yes, I just had to remind the folks.
It never ends anymore.
No, there's
There's
about a
companies reporting
two-week period, yeah.
every day, I feel like, even in the period that's supposed to be in between. We also have bank hearings continuing today. The House Financial Services Committee is going to take its crack at grilling regulators about what happened to Silicon Valley and Signature Bank. So that's something to look ahead to at 10 a.m. as well, although those comments likely won't be market moving. We got the opening bell there in our market check here, sponsored by Tasty Trade, as we look at that strength here coming out of the open this morning, and not anything to sort of disrupt some of the upward movement that we're watching for here on the major averages. So if you take a look here, you got the Dow, the S&P trading higher. The Nasdaq hasn't quite opened up yet because there are a lot more components in the Nasdaq Composite than the S&P and the Dow. It takes it a little bit longer on occasion to get that opening level for that index, and there it is. It's up about 1.2%. So we're seeing more strength on the tech side. Also interesting, again, to refer to our comments with Anastasia in our conversation, tech is something that she likes right now. She's talking about a barbell strategy with tech on the one hand and some more defensives on the other. So it seems like she's not the only one with that idea. We've talked with some other investors as of late who are starting to look at technology here. So Brad, interesting to see that movement continue.
Love a good barbell strategy.
Yeah.
Let's take a look at the Dow Jones Industrial Average up over the past 3 days. So this week, as we scratch hump day here and begin the trading session, we're about 1 minute into the activity. Dow Jones Industrial Average up 0.7%. Nasdaq Composite, as you mentioned, Julie, up by a little more than 1.2% right now out of the gate. And then the S&P 500, you're seeing that up by nearly 1% on the morning here. Let's also take a look at some of the sectors within the S&P 500. 11 sectors, we've got them loaded up here on the screen for you folks. We've got some green across all of those 11 sectors. As of right now, the leader on the day, yep, just stay right there for a second, XLRE. You're seeing that hold on to gains and move higher, leading the S&P 500 11 sectors, and that's up by about 1.5%. XLK Technology also doing good on the day. That's up by about 1.3% out of the gate. Let's take a look at technology. Speaking of this, with the heavily weighted Nasdaq 100 on the technology front, as you're seeing some of the biggest gainers there. Lulu, that'll really set up our conversation on the other side of the break. Shares up higher as we kick off today's trading activity by about 13%. And then taking a look at some of the Dow components as well. The Dow 30, really just one laggard right now, and that's Merck. Merck is down by about 0.2%. We'll dig a little bit more into that later on, but Intel actually leading the charge on the Dow Jones Industrial Average right now. So largely sea of green there, 29 out of 30. It's not too shabby.
Yeah, very interesting. I guess Micron not hurting matters when it comes to Intel and some of the other tech. We're going to take a look at some more movers after the break, so stay with us. We got much more to come.
Shares of Lululemon on the rise after topping estimates in its latest quarter and issued positive guidance for the year. Shares are up by about 13% right now on the earnings call as well. The company talked about the backdrop and getting through a challenging macro backdrop despite some supply chain issues and the pressure of COVID-19 in China. However, at the end of the day, to remember, it's not a large markdown business like some of its competitors, and it does not lean heavily into discounting as much as I do walk straight back to the we made too much section when I go into Lululemon. You know, I still am a person that's willing to pay full price, and they see that within much of their business, and that's what they've been able to lean into, especially in this time where many of the other competitors have had to do some deep discounting to move through inventory.
I'm old enough to remember when we made too much wasn't even in the store. You could only get it online initially. Right. They did not put that in the store. So even though they don't discount as much as their peers, they do discount more than they used to, certainly when you look at Lululemon. And by the way, that strategy to not discount is cost them. Yes, their sales are holding up quite well. Sales up 30% in the fourth quarter, and full year fiscal 2023 sales are going to be up about 15%. So that's ahead of what analysts had anticipating. But their inventory is still higher, quite a bit higher, 50% up from a year earlier, and gross margin is down from a year earlier as a result of that and trying to get that inventory right size. So in other words, yes, demand is strong. Yes, they are still moving merchandise, but everything is not all sunshine and rainbows and, namaste over at Lululemon, although the stock is reacting as though it is.
Two things that I wanted to zero in on, and actually three. One of them, which you mentioned, is that this inventory, and I'd be interested in knowing what of the inventory is still really kind of holding them back here, because you think about the inventory that Lululemon has, and we've heard Adidas throw shade on them in the past and say it's kind of basic at the end of the day. And so if it is inventory that they see as being able to move through in any season and just holding on to that and then pushing it back into stores, knowing that it's going to be one of either the best-selling hoodies that they do have or some of the sweatpants or the leggings and whatnot, then that's multi-seasonal that you can sell that. So now it comes back to, all right, even within where you're engaging with the consumer, where they saw 10% increase in company-operated stores, e-commerce growing 46%, all of those measures are going to be significant in moving through whatever that inventory is that they're still seeing at least a certain percentage of glut in. And then the other side of that, on the sneaker category, I'm just continuing to look for updates on this. They released the new Blissfeel 2. They said this updated version of Blissfeel incorporates learnings from the initial launch, which just signals to me the initial launch didn't go perhaps as best as planned. But again, it was kind of a test to see how they could do in the sneaker category. However, I have tested out the sandals. They should do more sandals. I'm not the sneakers.
One more thing, just to mention Mirror. Remember that business that they bought? They are taking a write-down related to that business. They are pivoting to focus more on the services side of the business, the partnerships they have with live fitness classes. And so what do they call it? Lululemon Studio, I believe is what that business is called. So that's just something to note as well, that business did not really work out as planned for them, but a lot of other stuff seems to be working out just fine. As I always cop to, I'm a big fan of the product, gotta say. Not Mirror, just in general. Lululemon,
Same
in
here.
general.
Same
in
here.
general.
Almost every day. My hoodie this morning.
Nice. Let's talk about another mover here. That's AMC. It surged 13% yesterday after a Substack report suggested that Amazon may consider purchasing the movie theater chain. Shares of AMC have since come down. We got Brian Selzy got a no comment from AMC CEO Adam Aron, and there are some analysts who have thrown cold water on the idea that this would happen, would make sense, was imminent, right? So we're seeing the shares come down a little bit today. And again, it's not clear where exactly. We know it came from a Substack, but we don't know the source of this particular report. But just also kind of shows how much attention is still on the meme space when you do get little glimmers that people like to latch on to.
Right. And
there's also still a lot of short interest that can cause it squeezes upwards.
Sure. And if anybody is wondering what Amazon might even want with AMC, well, according to the reports, the insider here had said that the e-commerce giant views a potential acquisition of AMC AMC as a means of obtaining brick and mortar kind of marketing way stations. So what does that even look like? They could promote kind of Amazon Prime videos within that. They could have a plethora of other Amazon services that would essentially be able to be offered through these AMC brick and mortar distribution hubs, as you might be able to kind of look at it, or Amazon might figure to rebrand it at that point. But
yeah, some analysts over at Wedbush said that maybe Amazon would be better off buying a piece of Cineworld, which is another theater chain that has had some financial troubles. And by the way, on that point, later in the 4 p.m. hour, Yahoo Finance is going to talk to one of the folks at Wedbush. That is Michael Pachter, who's going to have more on Amazon and what it might see in AMC or what it might not see in AMC and kind of its strategy going forward.
I'm calling out Michael. You know why? This picture is not representative of how he shows up on air with us. He's wearing a t-shirt all the time. Michael, I love you, my man, but we never see you in a tie. Let's just put this in a t-shirt.
Yeah, let's do it. I like it.
All right, Dave & Buster's tops estimates in the fourth quarter on the top and bottom line. However, noting sales in the current quarter roughly flat relative to the same period last year. Take a look at shares. They are down by about 4%. It's been interesting to watch this company. I actually had the privilege of working on this company's IPO back in 2015, 2016, somewhere around 2015.
When you were at the Nasdaq, right?
I was, yes. And so within how far the experiential type of element that they offer, of course, they want to make sure that people are playing, eating, drinking, watching anything at Dave & Buster's. During the pandemic, of course, a big drawdown in the number of people that were willing to go into these high-touch capacities. I think for Dave & Buster's, what they've been able to show, though, is they're just trying to drive robust, comparable walk-in sales growth. Their special events business, that's also going to be key here. They're saying that's continuing its recovery towards pre-pandemic norms as well. So that potentially something to keep an eye on in future quarters.
Look at that chart, man. Look how up and down that chart is. That is an unusually jagged chart that we have seen for Dave & Buster's. And really, it looks like that the declines here today on the company's comments that sales comps are roughly flat to down very low single digits in the first quarter. That seems to be hitting. And I'm seeing a little bit of a commentary from analyst, a Truist analyst, Jake Bartlett, saying that comp sales have been more resilient than expected, but they have been volatile, much like that stock chart. And quarter to date trends, he says, are not likely to settle investors' nerves in the near term. So, even though a lot of people are back out there, are they back to Dave & Buster's? They were last quarter, but I guess there's still some question about how consistent that is going to be.
Yeah, that IPO I was talking about, that was 9 years ago. That's 2014. My goodness. I don't know.
When's the last time you've been in a Dave & Buster's?
Probably around that same year, actually. Yeah. Coming up, everyone, while the turmoil in the banking sector isn't like 2008, we'll discuss next. fear over insurance limits, risk among regional banks, and concerns about the commercial real estate market. These were all issues that surfaced during the banking crisis of 2008. But as the Fed and other central banks have made clear, the current turmoil will not stop them from further tightening this time around. Meaning this isn't a repeat of the past. You can read all about this in today's morning brief written up by Miles Udlin. It's up on the Yahoo Finance homepage. But for more on the current banking crisis, we welcome in Patrick Armstrong, the Chief Investment Officer for Plurimi Wealth. Patrick, great to have you here with us this morning.
Morning.
If there is any comparison or contrast between 2008 and now and the Fed's action, what would you kind of prescribe or even label onto what we're seeing now versus then?
Well, I think the Fed reacted very quickly, along with the deposit insurance, Janet Yellen, when SVB did collapse. Over that weekend, they ensured all depositors were made whole. They found buyers for the international arms of SVB, and they really tried to limit any contagion possibilities. So other small banks obviously saw massive outflows, and larger banks have started to put deposits with the likes of FRC, things like that. But it's been the Fed's policy that's started to create cracks in the financial system, I suppose, as well. It's been a very aggressive tightening cycle. And historically, when you look at Fed tightening cycles, they hike until something breaks or a recession is caused. And this may be the early warning signs of that, but I don't think this is the first of a range of dominoes to fall. I think there are many idiosyncratic things with SVB and with Credit Suisse in Europe.
That said, are there other things that are going to break within banking? Part of what you do is looking for those vulnerabilities, right? Because I know that you have some short positions. So where are you seeing maybe some other pending vulnerabilities?
So I'm short Bank of Nova Scotia in Canada. That's a country that's had an incredible property boom. The big cities in Canada have seen property prices outstrip all the other major cities around the world, fueled by low interest rates that all assets grew by. But Canadian property in particular had very strong growth. And Canadian banks have been seen as a bit of a safe haven because in the financial collapse in 2008, all the Canadian banks were really escaped without any exposure to subprime, and Royal Bank of Canada became the biggest bank in the world back in 2008 even. So it's, I think they've got a bit of glow around them of good management. I think there was a bit of good fortune, but banks around the world, you're picking up at fractions of book value. Canadian banks are still trading at multiples of book value. So I think they're too expensive and they do come with some risks as well.
And I believe there's a report that you were also short Goldman. Can you confirm if that's so and why?
So I was short Credit Suisse all of last year. I closed my Credit Suisse short in early March, and I moved that into Goldman Sachs. And I'm not short Goldman Sachs anymore. So early March, I shorted it. It fell about 15% and recovered it. And I was worried about, if you look at the stress tests, the Fed do stress tests of all the banks. In the consumer adverse scenarios, Goldman Sachs surprisingly performed very poorly in that stress test. So it's not a bank people think of as large consumer exposure, but in an adverse scenario for the consumer, Goldman Sachs numbers didn't look as strong as you might expect. So it was trading at a premium multiple and was exposed to a consumer risk that showed up in their own stress tests.
You do own Citi and BBVA. Is there any exposure that is similar to the banks that have already seen their issues and have either collapsed or have had to have some type of kind of saving come into play, where they might be exposed as well on Citi or BBVA side?
So Citi's had its issues, not as bad as Credit Suisse in terms of management controls. It's transferred $1 billion of assets to an account they didn't mean to. They've been fined as well. So I think they've got some management control and regulatory issues, but not to the same extent of Credit Suisse. It's not really impairing their balance sheet. It wasn't as exposed in Archegos, things like that. So there comes risk with Citibank. It's a big bank, unwieldy, but it is, again, systemically important. Trading at a fraction of book value, very low PE. So I don't mind paying those kind of multiples when there is some risk. It's not suffering outflows. It's been a beneficiary of all the small banks having an outflow of deposits. The big systemically important banks are getting those deposits. So that's going to cover up any holes as well. When you have deposit outflows, holes are exposed. Large inflows of deposits, you can cover up any holes as well.
Yeah, really interesting stuff and actionable stuff for investors. Patrick, thank you so much for being with us. Plurimi's Patrick Armstrong. Coming up, Jamie Dimon reportedly being deposed in the Jeffrey Epstein lawsuits. That's according to several reports. Yahoo Finance's Alexis Keenan has the details next. Various media reports suggest that JP Morgan CEO Jamie Dimon is set to give testimony on his bank's ties to former client Jeffrey Epstein. The investment bank is facing 2 civil lawsuits over the bank's relationship with the disgraced former financier. For more on what we can expect, let's get to Yahoo Finance's Alexis Keenan. These cases just keep going, and there are just tendrils seemingly everywhere.
Yeah, and I think we can expect that they will continue to go on for quite some time. This is not a fast-moving matter, and there are 2 of them. So there's multiple lawsuits that we're talking about here. And I think what we can expect is that Jamie Dimon is possibly confident that there's no paper trail or digital trail connecting him to knowledge of Epstein's alleged wrongdoing. Now, remember that he, before his suspected suicide in a New York jail, was accused of running a sex trafficking ring for decades, for years, involving minors. And so the Financial Times is the media outlet that's coming out with this report today, saying that Dimon has agreed to be deposed in both of these cases. He will give testimony under oath, they say, in May. And the 2 cases, one is brought by the U.S. Virgin Islands. They allege sex trafficking law violations as well as some fraud allegations that they're bringing the bank into. And the other case is brought as a purported class action by women who say that Epstein abused them in the course of his wrongdoing. Now, what's interesting about the Virgin Islands case is that the judge in that case has already ordered JP Morgan to turn over documents belonging to Jamie Dimon. And those are for communications that are after the time when Epstein was a client of the bank. And also included in this case more recently is a third-party complaint that JP Morgan has brought against one of its former former wealth managers, Jess Staley, who it says JP Morgan is pointing the finger at Staley, saying he's the wealth manager who had the direct relationship with Epstein, and we did not know about his activities. In a statement, the bank has said that at no point did Staley disclose to JP Morgan, nor did JP Morgan know about Staley's personal activities. In a separate statement to Yahoo Finance, the bank said we could not have imagined any of our employees would engage in the type of conduct alleged in these two cases.
And so within this as well, Jamie Dimon, one executive that allegedly has some ties to Epstein, and there have been other executives photographed with Epstein before. We just showed former President Donald Trump. We also have seen photographs of Bill Gates even with Jeffrey Epstein in the past. Is there expected to be any type of testimony that comes forward from those figures in the future as well?
So these cases, they're still in discovery, meaning the parties are still asking for information to be exchanged between them. And certainly we'll be looking out for those filings to see what names pop up. But in this case, the plaintiffs, they are going after the pockets they consider to be very deep, and that is JP Morgan. So I wouldn't be surprised if we see others brought in here. These cases have a long way to go, but certainly the wheels of justice are at least turning, because Jamie Dimon is stepping up here reportedly and facing these plaintiffs to say, I will testify here. But it definitely shows perhaps some confidence by the bank, by Dimon, that there is no direct connection, right? Because that's how these cases turn. It's, did you know about this alleged wrongdoing? And if so, why didn't you do anything about it? Employers can be held liable for the actions of their employees, in this case, Staley perhaps, maybe others, if those employees are acting within the scope of their employment. JP Morgan has a strong code of conduct that its employees sign to say that they need to bring forward any relationship and other conflicts that could damage the bank. So one would expect that also JP Morgan's third-party complaint going after Staley and any other allegedly involved employees would be quite strong, because they did sign on the dotted line to say we would bring those things to light if there's wrongdoing that we have suspect going on.
Interesting. All right. Well, thanks for covering it for us and continuing to track it. Appreciate it. I want to bring you a quick trending ticker. Lucid shares recovering some ground this morning after slumping yesterday. Actually, they're not recovering anything right now. On plans to cut 1,300 jobs, amounting to 18% of its workforce. The move forms part of a broader cost-cutting strategy as the EV maker enters its second full year of production. It's worth noting that Lucid recalled hundreds of Air sedans at the start of the week on a power loss issue. Well, don't overlook Lyft. We're going to chat with the ride-sharing company's incoming CEO in the next hour, and Howard Schultz in the hot seat. Starbucks' former CEO faces a grilling over at how it handled labor unions. Joining us with a sample of what's to come, Yahoo Finance's Rochelle Lacufo. Hi, Rochelle.
Hello, always good to be in the early show. Now, we're watching those changes at Lyft. David Risher taking over as president and CEO starting April 17th. Current CEO and co-founder Logan Green, he will now chair the Lyft board. President and co-founder John Zimmer, he will move to vice chair, so a bit of movement there. To give you some background, Risher does have some Wall Street cred. He's a former GM at Microsoft, senior vice president of US retail at Amazon when it was scaling from the late 90s into the behemoth it is today. And then most recently, the founder and CEO of digital book platform WorldReader. Now, I'll be asking him how he plans to apply all that experience to Lyft, because Risher still wants to focus on the ride-sharing business, but not really competing with Uber's growing ecosystem of delivery services, which has really been the growth route there for Uber. Now, Lyft's past two quarterly reports disappointed the street. So Brian Sozzi and I will dig into the potential turnaround and how Lyft plans to compete from here if they're really just focusing on the ride-sharing.
And so we're also set to chat the controversy around Starbucks and how they handle unions. Tell us more about that and what's being tracked there.
Now, this is going to be a tough one because former Starbucks CEO Howard Schultz will face off with Senator Bernie Sanders. Now, he's chairing the Health, Education, Labor and Pensions Committee, also known as HELP today. That's actually starting in just a minute or two. Expect a grilling hotter than your morning roast, as the hearing is titled, "No Company is Above the Law, Myth-Busting Starbucks Claims That It Has Not Violated Federal Labor Law with Impunity." So lawmakers are going to drill down on Starbucks' store closures and some of these firings tied to these growing unionization efforts. About 3% or 300 US stores voted to join the union Starbucks Workers United. And Sanders reportedly turned down having other representatives from Starbucks in place of Schultz, telling NPR Tuesday, "I hope that by the end of the hearing, what Mr. Schultz will say is that he's prepared to sit down with the union and negotiate a contract." But up till now, both sides have been accusing the others of undermining the process. It's going to be a tough one. Bernie Sanders will be coming for Howard Schultz today.
Yeah, definitely.
Absolutely. Rochelle Akufo, we're going to be tuning in to you at 11 a.m. Thanks so much for joining us here. All right, guys, and coming up, getting America online, improving the nation's internet access has been a long-standing issue, and we hear about the latest efforts with U.S. Commerce Secretary Gina Raimondo. Don't miss it.
Welcome back to Yahoo Finance Live. I'm Julie Hyman with Brad Smith. We've got housing data out right now. Pending home sales, it looks like rising 0.8% month over month. That's the third straight month it has seen an increase. It looks like here it also came in better than estimated. So analysts were looking for a drop of 3%, so got better than expected there. If you look across the different areas, and this is something that has recently been examined, I've seen in different maps and whatnot, the Northeast pending home sales up 6.5%, so seeing a lot of strength. In the middle of the country, in the South, seeing less than 1% gains, and the West falling 2.4%. So there is now this growing sort of regional dichotomy here. Pending home sales in the Northeast doing well and everywhere else not doing so hot. We did see mortgage rates higher during last month, but they have since come down. Data this morning showing U.S. mortgage rates going down to a 6-week low of 6.45%. So maybe we will see these housing numbers continue to improve. We'll see.
Yeah. And also, financial regulators back on Capitol Hill this morning for a second day of testimony on why SVB failed, this time before the House Financial Services Committee, back on the hot seat this morning. Federal Reserve Vice Chair of Supervision, Michael Barr, and then the FTC Chair, Martin Gruenberg, and Treasury Undersecretary for Domestic Finance, Nellie Leung. They're all going to be testifying in identical opening remarks this morning. Barr will again call SVB's failure a textbook case of mismanagement due to failure to manage its interest rate and liquidity. that risk, of course. Jen, we'll bring you in on this. Our own Jen Schonberger is tracking all of this. Jen, what's really teed up down there? What are you going to be listening for?
Hey there, good morning, Brad. You took some of the words right out of my mouth. That's right. Financial regulators back on Capitol Hill this morning for a second day of testimony on why SVB failed, this time before the House Financial Services Committee. You mentioned there we're going to hear from the Federal Reserve Vice Chair of Supervision, Michael Barr, along with the head of the FDIC, Martin Grunberg, and Treasury Undersecretary for Domestic Finance, Nellie Lang. We are going to hear identical remarks from Barr, who will again call SVB's failure a textbook case of mismanagement due to failure to manage its interest rate and liquidity risk. Barr, who is conducting an official review of why SVB failed and what should be done to prevent such failures, told Senate lawmakers Tuesday he anticipates strengthening capital and liquidity standards for banks with over $100 billion in assets. Today, expect House Republicans to push back on Barr for strengthening rules, challenging that the issue is not the lack of rules, but the failure of examiners to properly police how SVB manages risks. In opening remarks, Maxine Waters, the top Democrat on the House Financial Services Committee, who spearheaded briefings from regulators on SVB's collapse initially, will debunk the Republican narrative about bank failures, saying, quote, "Let me be very, very clear. Silicon Valley Bank collapsed because of management failures and possible regulatory weaknesses." She goes on to say, "We must uncover how management, regulatory, and supervisory failures contributed to these events and explore solutions to strengthen the safety and soundness of our banks." She goes on to say the community banks should not pay for SVB's failure. FDIC Chair Grunberg told the Senate Tuesday that the FDIC board has discretion to decide which banks would pay for SVB's failure and implied community banks could be exempt. Grunberg says the agency is conducting a review on deposit insurance that is likely to be a very hot topic today, and we should watch for whether Republicans and Democrats could coalesce around some of these issues on deposit insurance, because that could pave the way for potential legislation on that front. Back to you.
All right, Jennifer Schonberger, thank you very much. And we're looking there at the beginning of that hearing, Patrick McHenry talking there as it kicks off. Well, separately, as part of the bipartisan infrastructure law, the Biden administration is making high-speed internet available across the country, or at least that's the goal. And they're using American-made fiber optic cable in North Carolina to get it done. They recently, or today, I should say, announced a couple of agreements with some fiber optic cable makers to expand capacity in North Carolina. We had a chance to speak with Secretary of Commerce Gina Raimondo on the push for affordable high-speed internet in the U.S. She is in North Carolina. It was an interesting conversation.
It is high time that every American has access to the internet. You can't go to school, run a business without it. Millions of Americans don't have access to the internet, particularly in rural areas. And President Biden has said enough is enough. And so we at the Commerce Department are investing $50 billion in partnership with states to make sure that every single American has affordable, high quality, high speed internet.
Yeah, it's something a lot of people take for granted, right? People who do have that access. So the announcement that you're making in North Carolina in particular is a capacity expansion on the part of a couple of fiber optic cable companies, cable makers. Can you talk to us about that announcement, how it came about, and how it's going to fit into this plan?
Yes. So, you heard the president at the State of the Union say, it's time to get back into the business of making things in America. We believe deeply in manufacturing, whether it's semiconductor chips or fiber optic cable. And the reality is, if we're going to connect every American, including the tens of millions of Americans who now don't have the internet, we're going to have to lay fiber all across this country. And that's an opportunity to make that fiber optic cable right here in America. So tomorrow morning, I will be with two companies, CommScope and Corning, both great American companies, both making announcements of expanding their facilities here in North Carolina, adding hundreds of high-paying manufacturing jobs, making the fiber optic cable necessary to connect people who live in rural America. So, it's incredible, right? Not only are we making sure every American has access to the internet, but we're creating high-quality manufacturing jobs in the process as we make enough fiber to connect everybody.
Now, this is something you and I have talked about a lot before. We've talked about the administration's efforts to bring manufacturing to the U.S., whether it's semiconductors or fiber optic cable, and that's filling those jobs, right? Filling those high quality jobs. Are the people there? Are these jobs that are going to require substantial training? What plans are in place on that front?
So as part of our implementation of the broadband, we are including workforce training. So we are working with every single state. In fact, earlier, I was with the governor of North Carolina, and we want them to show us, before we give them the money, how are you going to train enough people? And there are a lot of people to be trained, I should say. We think we're going to create over 100,000 jobs just, laying the fiber and connecting the homes on top of the manufacturing jobs. And so you say, do the people exist? Absolutely. There are many Americans who want to work. They need to be trained to work. And by the way, most of these jobs don't require a 4-year college degree, but they do require some training. If you have to learn how to connect a home, be a technician, be a wire splicer. There's different kinds of jobs. We are going to work in every community with high schools, with community colleges, with labor unions, finding and training folks. And that's, for me, that's what's so exciting. Like at the end of this, when all is said and done, every American will have the internet, so they can go to the doctor from home, do schoolwork from home, start a business from home, and we're going to train and hire over 100,000 Americans, which is, something that's really exciting, and it's why we call it investing in America.
I want to ask more broadly about the broadband access here, because, of course, making and laying the cable is only part of it, right? You have to have the service providers on board. And it's not just rural Americans that have problems with access, right? You saw a lot of kids in urban and suburban areas during the pandemic in particular who were, there were stories about kids sitting in cars trying to get Wi-Fi signals in various places. So how holistically are you looking at the broadband issue, and how are you going to address all of that?
Completely holistically. And I should say there's no one size fits all solution. The way to connect everybody in Hickory, North Carolina is a different solution than in Providence, Rhode Island, where I'm from, which is, an urban area. By the way, you mentioned in your car, this library allows people to access the internet in the parking lot 24 hours a day. The library is not open 24 hours a day, but people come here 24 hours a day. They sit in their car in the parking lot to do exactly what you just said. So that's why we're working with each state. We're asking each state to give us their own state plan for how they are going to connect everybody in their state. We're also working with, this is a public-private partnership. The government isn't providing the internet. The government is working with private sector, cable companies, internet service providers, local co-ops, et cetera. And it'll be different in every state. And so we want to work with every ISP to make sure that they are providing the internet, and again, that it's affordable. It isn't enough that they provide it. I was just talking to some folks here, they pay $150, $200 a month. That is not affordable. We want high quality service at a price that the average consumer can afford.
That was Commerce Secretary Gina Raimondo talking about the broadband expansion efforts. And as she mentioned, she was at a library in North Carolina where a lot of people go to get that access. Let's talk about a trending ticker now. Foot Locker hit with a downgrade by UBS from neutral to sell. UBS also cut its price target on the footwear retailer to $30 a share from $36 a share, noting that conversations with investors suggest the market is not focused enough on the downside risk to sales. UBS warning Foot Locker is going to struggle to meet revenue expectations in a recession. And by the way, UBS also downgraded some other retailers. The share's not doing that badly, though. They're down just about 0.2%. Our Shauna Smith's going to be along in a bit to talk about some retailers overall, including Lululemon. Coming up, former Starbucks CEO Howard Schultz is in the hot seat. We'll bring you the latest. Oh, look at Bernie. I'm sure he's on fire. We're going to be back with more next. Quick check of the markets now, sponsored by Tasty Trade. We've got stocks hanging on to gains today. The Nasdaq's in the driver's seat, up 1.3%, followed by the S&P up 1%. The Dow gaining about, let's call it 2/3 of 1%. So, seeing some strength here in today's session. Let's turn our attention to Capitol Hill. Former Starbucks CEO Howard Schultz is facing the Senate Health, Education, Labor, and Pensions Committee today over criticisms of the company's labor practices. Yahoo Finance's Brooke DePalma has been listening in on that hearing. I think we're still on opening statements there, right?
Just on opening statements.
And we saw a picture of Bernie Sanders before, and I think he's the chair of that committee. I think we're expecting his comments to be barbed, perhaps.
That's right. Well, it's kicking off the Senate hearing right here. He's already giving Howard Schultz and Starbucks about 14 days to reach a conclusion here when it comes to this unionization efforts. Those that have voted yes to these stores, of course, this is in accusations that they waged an aggressive and illegal union busting campaign under Howard Schultz's leadership. Now, the former Starbucks exec is expected to emphasize in his prepared remarks that Starbucks should have a direct relationship with its partners. They still believe that is fundamental Starbucks culture and success. Schultz is expected to say that they have engaged in good faith bargaining And more importantly, that the union's wrongdoing is the reason why no conclusions have been reached here, saying, quote, however, union representatives have improperly demanded multi-store negotiations, delayed or refused to attend meetings, and insisted on unlawful preconditions such as virtual bargaining and participations by outside observers. Now, of those stores that have voted yes, the labor organization Starbucks Workers United is behind that effort. And when I asked them what exactly they hope to get out of today, they said, quote, we hope this hearing exposes Starbucks' illegal union busting campaign, exposes the truth about how Starbucks really treats their workers. They went on to agree with Senate Chair that Howard Schultz is the quote-unquote architect of Starbucks' anti-union campaign, has driven Starbucks labor policy. Now, it's important to note here that of the stores that have voted yes to unionize, rather, there's 293, a small portion of Starbucks' total 9,000 U.S. company-owned stores. But Starbucks Workers United did announce that during the annual meeting last week, 7 more stores filed to unionize. Of course, they still have yet to vote on whether or not that will proceed. But in today's hearing, we're expected to hear from a variety of different folks, including Maggie Carter, one of the first baristas at a location in Knoxville, Tennessee, to unionize. We're also set to hear from a worker that the NLRB says was fired after looking and trying to unionize his location, along with labor experts and legal experts across the board. But of course, this comes as Howard Schultz is set any moment now to make his remarks when it comes to these accusations.
So what sort of implications or even precedent could this hearing set?
Yeah, well, Starbucks is known to give out a higher minimum wage. They're known to set their college tuition program. They're known to give mental health benefits as well as other perks and benefits, they call it. And so ultimately, this could lead to a wave across the industry. What precedent is set at this meeting? When I spoke to one analyst yesterday, Sean Dunlop of Morningstar, he said, quote, Starbucks has long been perceived as a leader in the restaurant space with respect to the employee value proposition. So to see the unionization push strike at the coffee chain reverberates across the rest of the industry. Of course, we're already seeing this. Chipotle store in Michigan voting yes to unionize. And so certainly setting a precedent here, and we'll continue to tune in all day.
All right, Yahoo Finance's own Brooke DePalma tracking this, and you've got your headphones with you on set. We'll let you put those headphones back in and tune into what's going on. Thanks so much, Brooke. And switching gears here, shares of Lululemon, they're surging today after the retailer posted strong holiday sales figures showing strong demand despite rising prices. Yahoo Finance's Shauna Smith joins us now with a breakdown. Shauna.
Hey there, guys. Well, there are a number of retailers on the move today. We had UBS downgrading a number of stocks, but let's start with Lululemon because of the outperformance that we're seeing in this name. It's a top trending ticker on Yahoo Finance right now. Another very strong report here from the company. You can see right here, beating on both the top and bottom line, really showing that demand for athleisure is still intact. Now, a few standout numbers, 39% gain in digital guidance. Also very strong. Lulu forecasting a 18% sales growth for the current quarter, 15% growth for the year, both ahead of consensus. Now, Barclays analyst Adrienne Yee telling me that her quarter-to-date checks showing that Lulu is, quote, off to a strong start. So really reiterating some of the guidance that we got here from the company. Some improvement also on inventory levels. We know this has been a massive challenge for Lululemon and a lot of its competitors. Still up more than 50% from a year ago, but coming in better than what the street was looking for. Let's talk now about Mirror. Now, Lulu, it seems to be pivoting away here from the business, absorbing that $442 million charge. So won't be taking up much more, I should say, of management or capital resources. Now, CFO Megan Frank acknowledging on the call the misstep here last night, saying that the at-home fitness space has been very challenging. The hardware sales have not matched expectations. Remember, Lulu bought Mirror for $500 million in June 2020. So what's Lulu doing with its digital business, its digital content? Well, they've announced a new 2-tier app-based model that's launching this summer at a lower monthly rate. In terms of the street's reaction, Wells Fargo thinking that the pivot could help Lulu expand its total addressable market, although obviously likely to be a very small contributor to the retail sales. And guys, remember, Lulu has this goal of doubling its 2021 revenue by 2026. They want to do that to $12.6 billion. We'll see whether or not they get there.
I've been helping them.
So have I. I know. It's so addicting. You go in the store to get one thing. I always come out with more every time.
Also, as I mentioned earlier, there's a UBS call out on retail that is quite interesting today.
Yeah, it is interesting. It's also interesting when you take a look at the reaction, or lack thereof, I guess we should say, that we're seeing in some of these names. Now, we initially saw Foot Locker, one of those names under pressure, had been off just about 2% right at the open, but regaining some of those losses. Urban Outfitters, Ross Stores, also among the names that analyst Jay Sol downgraded to a sell here. Why? Well, he's saying that he's turning increasingly bearish here on some of these clothing and footwear names. When it comes to why he's making this case, well, he's saying that some of the checks and some of the data that he's been looking at from UBS in terms of consumer spending, well, they have started to fall off a little bit, and he does not see these names outperforming in a recession. So lots of worry, guys, here on what exactly the future holds for some of these retailer names. We heard from Foot Locker CEO Mary Dillon earlier this week on Yahoo Finance. Brian Sazzi spoke to her. She was obviously, to no surprise, very bullish about Foot Locker's future here, talking a lot about the renewal of the brand and that renewed partnership that the company has with Nike. But at least when it comes to Jay Sol, the analyst there at UBS, he thinks that turnaround might take some time given the macroeconomic environment.
I always love that his name is Jay Sol.
It makes so much sense. He had to cover some of these footwear
Sneakers,
names.
yeah, for sure.
Exactly.
Those names,
He was born for the job.
He was, and he followed through.
Yeah.
Thanks so much. Shauna Smith, you can get Shauna on the 3 to 5, wrapping up all the market activity here on the day and thereafter. Thanks so much, Shauna.
Thanks, guys.
Absolutely. Guys, coming up, how the state of the housing market is impacting the materials business. We're going to speak with the CEO of Trex on the other side.
Shop Talk. It's one of the biggest annual retail conferences of the year. All the big retail names are here. The Silicon Valley giants, Amazon, Google, and PayPal, and the giants of Main Street, from Foot Locker to Walmart. These are the three main trends we spotted here at the conference. AI, aka artificial intelligence, is having its moment as the ultimate buzzword in the field of investing, and AI is definitely on display here at Shop Talk 2023 as tech companies try to work with retailers to monetize a lot of the big data they are collecting in real time. AI very much on the minds of people we spoke to here.
I think as we see this next generation of AI, it is really powerful. And so I think one of the most important questions out there is, what are people going to ask the AI to do? And are people asking the AI to do things that are positive and helpful, things that are additive, which is where we're focused, is making sure that we're making really helpful recommendations for people that help them build a life they love.
We dramatically innovated, invested in what you would call automated storage, retrieval systems, state-of-the-art shipping sorters, state-of-the-art technology that allows us to pick, pack, ship, etc. And having now been 3 years into the journey, we're seeing improved safety, we're seeing improved productivity, and lower cost structure.
The second major trend here is shipping, and there's a race on getting all those products you buy online to your doorstep even faster. Here at Ship, they're trying to get you your packages faster than the next person. In Target stores, oh yeah, Target owns Shipped. In Target stores, there are Shipped employees picking goods off the shelves, putting them in a box, and delivering them right to your home. 22 billion packages are shipped every year in the United States. UPS, FedEx, and the Post Office ship nearly all of them. The size of the package delivery market is expected to hit $157 billion this year, helping to explain the focus at Shop Talk on delivery solutions. And the third big trend here at Shop Talk is buy now, pay later. With the economy under pressure, buy now, pay later services like Affirm and Klarna have a big presence here at Shop Talk 2023. According to a recent survey, more than half of all consumers in the US said they are currently using a buy now, pay later service. The average loan is $883. Clothing, electronics, and furniture were the top 3 items financed. Until next year, Shop Talk. By then, AI will only be faster and even smarter.
Pending home sales coming in better than expected this morning as consumers continue to face high interest rates. But how is this impacting housing material brands? Well, Trex CEO Brian Fairbanks joins us now. Brian, great to have you here in studio with us this morning.
Yeah, great to be here. Thanks.
Absolutely. So, a lot of people who, over the course of the pandemic and even a little bit thereafter, looking at the DIY home projects or even constructors that you work with looking at what products and materials that they need to take on? Your company really prioritizes more sustainability around these build outs as well. So what kind of success have you seen over these past couple years, especially leading into this year too?
Yeah, one of the things that's really unique about Trex is we've had a sustainable culture since the day we started business. Our founders recognized that we could use recycled material into our products. We started that over 30 years ago. Move forward to today, we have class-leading products. We're the market leader in composite decking and railing, and we still use over 95% recycled and reclaimed material in our deck boards.
And what kind of trends are you guys seeing right now, right? I mean, we just talked about pending home sales. We have definitely seen the housing market come off, but how closely do your sales coincide with or correlate with what we see in the housing market?
We're 90 to 95% repair and remodel, so we don't correlate particularly tightly with the new home build side of things. And the outdoor living part of the market has continued to outpace the rest of remodeling. That's where our primary focus is, and it is a very low-cost way to be able to add square footage to your home.
That's really interesting that you say that, because we've definitely seen home decor, the inside of the house in large part, take a hit, right? Furnishing companies, home decor, we have heard about weakening trends from some of those. But it sounds like you say people are still spending on the outside.
They absolutely are, especially that higher end consumer. And there also is a trend towards moving that indoors out. You see more outdoor kitchens today. You see more living room type furnitures, TVs being put in outdoor environments. All things that continue to benefit Trex.
Now, when you think about your time at the company, I mean, you've managed through past financial downturns, or economic downturns rather, and now, even as we're talking about what is perhaps the most telegraphed, as some of the economists that come on our show have described, the impending recession, how do you even see that start to show up in Trex data to make the business decisions, make the management decisions that you need to as well in order to navigate through that?
Yeah, the impending recession we keep hearing is 6 months out. And even in our last earnings call, we talked about the back half of the year being the more concerning part of it. Today, as I mentioned, we do see that higher end consumer is still very active. Our contractors still have reasonably long backlogs, still seeing good consumer demand out there. The question will be, how does that consumer hold up as we get to the back half of this year? And we're preparing ourselves, making sure that our inventories aren't too high. We're making sure that our channel doesn't have inventories too high. But if we see that consumer hang in like they have during the first part of the year, we'll have the ability to bring production on and serve whatever needs are there.
Yeah, because I wonder how much higher interest rates affect you all as well. Obviously, it's not as big a purchase as a house that you have to finance, but surely some percentage of the projects that people are doing with your materials are financed projects. So is that causing any kind of headwind?
It's not as much that there's that many people that finance their deck. There are some that do that, roughly 10-15% type range. But the bigger impact is going to be the lack of people moving up into that next larger home. And rather than moving up, improving on the existing places that they live, back to that point where a deck is a relatively low-cost way to add space onto an existing home.
I want to go back to sustainability for a second, because I am curious, even though you guys have been in that game for a long time, how the sales pitch has changed over time. In other words, when someone buys a Trex deck and you sort of survey them, is sustainability one of the biggest reasons? Is it durability? And how has that changed over time?
If we go back 10 or 15 years, we were sustainable because we felt it was the right way to run the company. We had the best cost basis to be able to purchase those materials to put into it. Going back over the past 5 years, sustainability is much more important to that buyer. Today, that's something that they're looking at. Price, aesthetics, durability, and sustainability is in that top 5. And especially as that next generation comes through, as they're making product decisions, they're looking for those green credentials, and they're not looking for the company just to say they have green credentials. They want the proof that these are green products, and that's something that Trex can deliver.
You guys use plastic bags as one of the raw materials, right? There's a lot fewer plastic bags now, right? A lot of, we know you got to bring your bags to the grocery store now. Do you have any trouble getting that raw material?
We talk a lot about plastic bags because the consumer understands plastic bags and they see this is the type of plastic that's going into it. 5 to 10% of the material we source is those plastic bags. A lot more of it is coming out of distribution centers where it's the pallet wrapping, where it is manufactured products that are being protected with plastic going into industrial environments. That's the lion's share of the material that we're buying.
This is sort of a geeky question, but how has that process changed over time? Like, are you guys producing the same way that you did 10 years ago, 20 years ago, or has the manufacturing process changed? Like, how do you make a bag into a board?
Yeah, what's interesting about using recycled material, every bale of material is different. And we have experts that understand, how do I manage a bale of plastic that has maybe 15% contaminant in it versus something that has 5% contaminant? And depending upon the types of contaminants, how do we manage that? We have adjusted how we manufacture with those products as the plastic has changed over time. And a lot of technology has gone into both the processing so that we can make plastic that's more consistent to go into our line, but also the way we run that material into the manufacturing lines itself.
All right. Brian, thanks so much for being here. This is an interesting conversation about decking. Appreciate it. Brian Fairbanks is the CEO of Trex. Thank you.
Thank you.
Coming up, a pulse check on the banking sector. We're going to speak with the CEO of Santander. That's next. Well, easy worries about the ongoing bank turmoil in the wake of Silicon Valley Bank's asset sales lifted risk sentiment for bank stocks. Federal regulators are still hard-pressed to create solutions that would prevent bank failures like that of SVB and Signature Bank from impacting the financial system. Let's talk about the banking sector more broadly, as well as new insights into U.S. consumer optimism. Santander U.S. CEO Tim Wennes is joining us now. Tim, thank you so much for being here. Appreciate it.
Thank you. It's a pleasure to be with you.
As a banking CEO, we have to start with what's been going on with the banks. And I'm just curious how you're feeling, how you have been sort of watching what has been unfolding in the U.S. banking sector. And by the way, also with the European banking sector, since your parent company is, of course, a Spanish bank. What are some of your sort of big picture thoughts here?
Well, trust and confidence are really important in our business and industry, and certainly some of the recent market activities have impacted that. So for us, it's been an opportunity to get closer to our customers and stay very connected to the customers. Some of those customers have questions or worries. And so we've been very proactive and active with our customers over the last few weeks. So it's certainly added more activities, but in many ways, what we're doing day to day in terms of helping our customers with their savings and investments or with lending activities, continues business as usual.
Among customers and regulators, everybody has been trying to figure out what happened, why some of the banks that did fail, why that happened, and ultimately it came back to the managing of the risk of its liabilities as well. So after you see that play out, what is the first conversation you have with managers at your business, supervisors, people who are also responsible for managing some of that risk?
Yeah, so we're very active in managing all of those activities and all the different risks associated with banking. But we're a very different business, right? We're largely a consumer business. The majority of our customer base is retail or consumer oriented, both in terms of deposits and in lending activities. So much of what we're doing is just very different than what we've seen here playing out recently.
Have you seen any deposits come out of the bank in the wake of what happened?
We've been relatively stable.
Well, that's a good place to be in this environment, most definitely. Again, to ask a bigger picture question, you guys have expanded a lot in the U.S. You now have, I was looking on your website, 485 branches in the U.S., a lot of them in the Northeast. What are the plans for the U.S., for Santander?
Yeah, so Santander globally is one of the 20 largest banks, and we've got over 160 million customers. Here in the U.S., we have nearly 5 million customers, just under 500 bank branches here in the Northeast, from Philadelphia up through New England. But we're also the 5th largest auto lender in the country. So our largest business is actually retail auto lending. And we've been expanding here over the last few years and are looking forward to continued growth in the U.S.
Well, some of that growth is going to have to hinge on the next generation of customers. Gen Z showed up within this survey that you ran as well. And one of the findings about Gen Z's respondents, they had particularly high levels of optimism. When you think about what's driving that and what's going to be the best way to go forward with a relationship with that next generation of bankers, how do you make sure that you author and maintain and foster even more of a relationship with that cohort as well?
Yeah, so importantly, what we did in January, we went out with a survey of middle-income Americans, and that is our customer base. The majority of our customers are middle income, which is defined by Pew between 2/3 of median income up through twice that median income. And we wanted to understand there's so many mixed signals out there, right? And in fact, the consumer is resilient today. We've still seen consumer spending holding up. We've seen continued activity in terms of borrowing, et cetera. But there's a lot of uncertainty. And as we saw in this survey, right, 2/3 of the respondents are concerned about recession. We saw inflation being very impactful, right, where more than half have impacted or changed their spending activity or reprioritized things because of inflation. But also that people are hopeful and hopeful that they still can be prosperous in the future and that their financial future is bright, right? Still 80% of the people think that in the next 10 years. The most optimistic is Gen Z, which is fantastic.
Yeah, just a quick follow on that as well. I mean, does it show up within consumers or your customers' banking activity that they are bracing for a recession of any sort?
We're still seeing consumer spending hold steady. We are seeing some impact in terms of customers' abilities to make payments. If you look at particularly our auto lending customers, because of used car prices increasing and interest rates increasing, right, the average customer loan payment's $100 or more higher today than it was pre-pandemic, right? So there is a real impact on everyday Americans and some prioritization that needs to occur. But I'd say in general, we're seeing activities hold up, and people are very focused on saving and investing. And in fact, that's the flip side of this. There's some positivity for those who have some savings and investments now can get a higher rate of return, even in FDIC-insured deposits, right? Yes. With money markets and CDs like they've not seen in over 15 years.
Yeah, definitely. Some of them, their adult lives for those Gen Z young people who are putting in deposits in money markets. I want to zero in on auto lending for a second, since, as you said, it's a big part of your business. What are you seeing there, particularly as rates move higher? Are you seeing any sort of deterioration in demand or differences in the decisions that people are making?
Yeah, so we've seen some impact in terms of demand and lending activity, particularly as rates have gone up with what's happened over the last year to Fed rates. we are seeing some normalization around delinquency. And during the pandemic, we saw very high levels of asset quality. And we've seen some return to normalization there as inflation has taken a bite out of people's paychecks there. But what we are seeing also is some resilience in terms of car prices. Right, used car prices are down year over year, but the last 3 months we've seen those stabilize. As vehicles are important for people. That also came out in our survey, right, where less than half of middle-income Americans have access to public transportation. Right, the job is their primary source of income and prosperity, and so three out of 4 people need that vehicle. They don't look to get a car loan, right? This is reliable transportation for them in terms of working.
Yeah, that makes sense. And then finally on auto loans as well, since there's so much attention right now to assets that banks have on their books, especially those that are interest rate sensitive assets, I'm curious about how the auto loan book works. In other words, the loans that you made a couple of years ago when rates were much lower, we've all learned these new terms like hold to maturity. Do you hold those assets to maturity? I assume that they don't have to turn over before that. How does that all work? If you
so look, the average car loan typically would have is fixed rate, which is good for consumers, right? That their payment's not going up despite other changes in interest rates. So it's a fixed period. Typically, that's going to be anywhere from 3 to 6 years on average. We see the average life of these loans is between 2 and 3 years. So typically, that car loan is paid off in 2 to 3 years. Either someone sells the car or they pay off that loan. So there's not a lot of risk with respect to that. And we're seeing, customers. The nice thing is they've been locked into that rate. If they got an attractive interest rate a year ago or 2 years ago, they're benefiting from that today.
Interesting.
Santander U.S. CEO Tim Wennes, great to have you in studio here with us today.
Thank you so much.
Absolutely. And coming up, everyone, tax mistakes to avoid in retirement. We're going to speak with an expert next. Inflation, raised interest rates, and longer lifespans are putting stress on those who hope to retire this year, according to a report out from Natixis. Joining us now to talk all things taxes and retirement, we've got Greg Kling, who is the associate professor at the University of Southern California's Leventhal School of Accounting. Greg joins us as part of our Retirement Ready segment brought to you by Fidelity Investments. Greg, great to have you here with us today. In terms of how people are preparing for retirement and trying to avoid some of the larger tax mistakes on that road, where should they start? What is the number one tip that you usually tell people?
Well, first of all, Brad, thanks for having me on this morning. Always happy to talk tax. You know, really, I think we could boil it down to what might sound a little bit obvious, and that's having organized and clear records. When I was in practice, one of the very frustrating things for myself and my clients was when they would bring in, we used to call it the shoebox. And the reason that it, just makes it so difficult is, I think you can see that then you really just don't know what items you should be putting on your tax return. So definitely having those organized and clear records is extremely important.
I'm laughing because I don't literally have a shoebox, but I can definitely picture what you're talking about, and I am not very organized. So this is a good tip for me to be taking to heart, Greg. Also, let's talk about when we're focusing on retirement here and tax mistakes that people make. How should we be thinking about the various retirement accounts and how they relate to taxes?
Yeah, great point, Julie. So first of all, I want to point out to everybody on today that there was a slight law change for retirees who are needing to take what we call required minimum distributions. And really, in a nutshell, the required minimum distribution means if you have, for example, an IRA, an individual retirement account, at a certain age, you must start taking at least minimum distributions. Well, for 2022, that age was 72 years old. So for the taxpayer attaining age 72 last year in 2022, who hasn't been taking distributions, they actually have to take their first one by April 1st of this year. So coming up in a few days. They'll also have to take another one by the end of December. They changed the law, Congress did, with Secure 2.0, which passed towards the end of last year. Now the age has been bumped up to 73 starting in 2023. So there's been some confusion around that, and IRS actually just recently notified taxpayers of that. One thing I also want to make sure is this rule does not apply to those folks who have a Roth IRA. Roth IRAs are not subject to the minimum distribution rules.
What about for people who have had to tap savings in their retirement accounts earlier or ahead of time? How can they best go about making sure that they're insulated and still have the right figure for retirement, number one, but also are reporting that correctly?
Yeah, great point. Well, what I would say is, of course, I'm going to say you should always have a good tax advisor helping you out here to sort through some of the details. But if folks have, let's say, tapped into their retirement accounts, a couple of things. If they've taken it before retirement age, which is 59 and a half years old, they might be subject to early distribution penalties, although there are some provisions in the law that allow folks to take it early. But let's say they're past 59 and a half and they're just taking their distributions. Again, I'm going back to having a good tax advisor, a good financial advisor, so that there's no surprises, so that here's what my tax bill is going to look like by April 15th, so that there's no surprises from a cash flow perspective.
Yeah, we definitely don't like surprises. Just very quickly, lastly here, how do you figure out how much your Social Security benefits are going to be taxed?
Well, that's a good question. There's actually two levels of taxation. It could be 50% or 85%. It also depends on what other income you have. So I think just to keep it really straightforward, again, I'm going to go back to have a good tax advisor, prepare your tax return using a tax preparation program, and I think you'll get the number. Now, if somebody says they want to look at it by hand, my recommendation is going to go to the IRS website and look at the worksheet that they have available.
Greg, thank you so much. Really helpful tips in here. Greg Kling, Associate Professor at USC's Leventhal School of Accounting. Thank you.
Thank you.
Coming up in our next hour, Yahoo Finance's own Rick Newman joins to break down how the Trump administration's cutbacks on banking regulation may be to blame for SVB's failure. You see here the House Financial Services hearing that is digging into that collapse, and certainly some of the members of Congress are pointing fingers at that regulation as well. A lot more to come here on Yahoo Finance today. Rochelle Kuvo has you covered for the next hour of trading, and she's going to talk to the incoming CEO of Lyft, David Risher, about his future vision for the ride-sharing giant as he gets set to take on his new role next month.
All right, scoop a ride. Also, Kevin O'Leary, a.k.a. Mr. Wonderful, will be here live talking all things from the fallout of Silicon Valley Bank to the current state of crypto and that market. You do not want to miss that conversation. Scoop a shark.
I would like to be known as Miss Wonderful from now on, and you can be...
Done.
Senor Wonderful, or we'll come up with some other title for you. Boy Wonderful? I don't know.
Yeah, why not? Yeah, DJ Wonderful.
Oh, I like that.
We'll get name tags made like Senator Murray.
Yeah, I like it. I like it, except ours will say wonderful on them. Former Starbucks CEO Howard Schultz, he's facing a grilling over how the company handled labor union battles. That's what's happening there, and that will continue to update you on that hearing as the day goes on. There you see Schultz right there in the hot seat. Let's take a look at markets before we leave you real quick here. And we have stocks remaining in the green here, Brad.
Yeah, we do indeed. And taking a look at the major averages up across the board, as you were mentioning, the Dow up 0.5%, S&P 500 by about 0.9%, and the Nasdaq Composite tech-heavy average up 1%.
Rochelle Kuvo has you for the next hour of trading. Stick around.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm watching this morning. A sense of stability returning to markets, with banking fears taking a back seat. The focus shifting to the path of monetary policy ahead of the Fed's rate decision in May. We'll take a temperature check with New Edge Advisors CIO Cameron Dawson. And the battle for the rideshare market is as hot as ever, and Uber's big competitor has a new CEO to lead the charge. We're joined by Lyft's incoming Chief Executive Officer this hour. We'll talk shakeups and the road ahead. And SVB's collapse made systemic risk the talk of the town. Lots to discuss with O'Leary Ventures Chairman Kevin O'Leary. We'll get Mr. Wonderful's take on that and all things crypto. You don't want to miss it. But first, let's check in on the major indices an hour and a half into the trading day. A positive picture here, though we are seeing some of that buying action slowing down. The Dow there in positive territory, though, up almost about 0.5% on the day, about 150 points. All of the S&P sectors in the green right now, also up about 31 points on the day. Tech-heavy Nasdaq also seeing gains there, up almost 1% on the day, about 115 points. Let's also check in on the Treasury market. We're seeing some of this pullback on the VIX, showing people aren't quite as nervous. We're seeing that reflected especially in the short-term yields there. The 5-year, as you can see, just slightly in the green there. The 10-year also seeing some gains there, 0.2%. And the long-term 30-year also just slightly in the green there. And just flipped negative as we say that. All right, well, the upward swing in markets indicating resilience in equities fueled by falling interest rates and strong earnings estimates. But is the optimism sustainable or supported by just a few strong performers? Let's get right to it. Joining us now on set is Cameron Dawson, New Edge Advisors Chief Investment Officer. Cameron, lovely to have you here in studio. So let's talk about this market action that we're seeing. How much of this is really reflecting this flight to quality?
Well, a lot of it we think is because there has been this big inflow into tech, and not just all tech. It's really been those that have this perceived quality and stability in the biggest names in the index. And so we see that the current market is really being held up by just a handful of names. But when you look under the surface, what you see is that only about 40% of the names within the S&P 500 are trading above their 200-day moving average. That means 60% of the names are below their long-term trend. So you're seeing some deterioration in the broader subset of the S&P.
So then how should investors play this then, if you just have sort of a few big boats lifting all the tides at the moment?
Well, we've certainly seen this at many points during rallies, and what often happens is that it could be an indicator of future volatility to come, just meaning that you have a little bit more of a shaky ground underneath the market. I think the other thing to remember is that we are barreling into earnings season very soon. In just 2 weeks, we're going to start to hear from the banks. And the really interesting thing is that despite all the turmoil that we've seen in markets and uncertainty about what's going to happen, earnings estimates have not been cut over the last 3 weeks. And so it will be very interesting to see if earnings are well calibrated for what could be the ultimate impact of the banking fallout.
Because we have seen some of these valuations start to get pressured then. So what are the expectations there?
Well, we do think that there will eventually be an earnings impact from the regional banking fallout. It's just a matter of time. It simply takes time for slower loan growth, which we think will be the first way that slowing banks will impact the economy and earnings, but it may not be this quarter. So we're going to be listening to what companies say if they're starting to pull back more. The other thing to remember, a lot of the announced layoffs that we got in the first quarter, big, huge companies announcing layoffs, a lot of them don't hit until the second quarter. So it takes a couple months for you actually to see the increase in unemployment possibly, or increase in initial jobless claims. So we'll be watching that closely.
So then what are some of the top 3 risks that you're seeing that perhaps investors really aren't honing in on enough?
Well, we do have a debt ceiling, and I think that that's probably not being priced into markets right now, meaning that we saw what happened in the last debt ceiling debate where we saw Congress really take us to the brink. And so that was a big source of volatility for markets when we look back to 2011. So we'll be watching that very closely in the coming months. And then, of course, it is this earnings story, and we're watching loan growth extremely closely, because one of the things that we see is that going into recessions, the best indicator that's a coincident indicator that you're going into a deeper recession is loan growth. And so if we see that SVB and what's happened within regional banks is the spark that causes loan growth to roll over, that's when we think that those earnings estimates may be too high and have to be marked down.
And I want to look at some of the recession signals here, because obviously a lot of people are looking at what's been happening with the 2-year yield and some of the indicators there. What is that telling you? And should we really be basing our predictions on the bond market? It has been a little bit unpredictable.
It is a really good point that the 2-year plunging is typically a fantastic signal that a recession is soon on the horizon, because what a 2-year yield falling rapidly says is that the Fed's going to have to cut interest rates very, very soon. Now, in today's environment, one thing that could be skewing that message is that 2-year yield positioning has been extremely short. We've seen record short positioning in what's the CFTC data. When that has record short positioning, you see a little bit move lower in yields. That causes a big move lower in yields. And so maybe it's amplifying these moves. So maybe the 2-year isn't as clear of a signal of oncoming recession as it was. But if we just look at history, it would say 2-year yields falling, curve re-steepening, that means trouble's on the horizon.
So then when you do have these sort of disparate signals at the moment, what is the play here going into the second quarter in terms of sectors that you like?
So what we've been seeing is that cyclicals have started to roll over pretty hard. That's consistent with a falling 2-year, that recession signal. So what we've been looking at is really wanting to keep a balance between our cyclical and our defensive exposure. Our defensives have really lagged to begin this year. You look at healthcare underperforming the market really significantly, and underperforming tech really significantly. So we're staying long in healthcare. We have a little bit of cyclicals within materials. In that event that China reopening works in our favor, or you have a much weaker dollar, that would be good for materials. And it's really keeping that balance. And the last part is keeping an overall overlay of quality. Now is the time where you want to focus on balance sheets. You want companies with really strong balance sheets that don't have to raise debt at high interest rates or generate a lot of strong free cash flow. And so whether you're looking at growth versus value, cyclical versus defensive, quality has to be a central tenet.
So then for people who are looking for a safe haven, we've had this discussion as we've sort of been looking at gold prices, looking at bonds. Could tech be the safe haven?
I think that that's a little bit dangerous to think it is the ultimate safe haven. Prior to the COVID recession, tech was a cyclical sector, or considered a cyclical sector, because it had earnings variability. It depended on what was going on with companies' tech spending budgets. So during recessions, companies would pull back, and so you'd see tech shares underperform. But in COVID, you had a period where tech actually was the only sector that grew earnings during that time. But that's because we were all locked in our houses and pandemic lockdown. So we don't think that tech is going to behave the same way in future recessions that it did in the COVID recession, which may mean that companies, or investors, are underpricing the potential earnings risk of technology in a recession.
You raise an interesting point, because so many of us were reliant on that tech, but it's a different game now as we're coming into this post-pandemic phase.
It certainly is. It certainly is.
Definitely good to note. A pleasure having you, Cameron Dawson there, New Edge Advisors Chief Investment Officer. Thank you for joining me this morning. All right, coming up, we check in on bond ETFs, how they've performed amidst the banking crisis and interest rate volatility. Stick around as we discuss next. Sticking with bonds, our last guest noted the bond market signaled a more risk-off approach in tech. But what about opportunities in fixed income? Now, interest rates are higher than they've been in years, giving investors the chance to retool and de-risk. For more on the opportunities in the bond market, let's get to BlackRock Global Co-Head of Fixed Income ETFs, Steve Lapley. Steve, thank you for joining me. So a lot of people wondering how to play the bond market right now. Obviously, we're seeing these inflows into these shorter-term yields.
Yeah, so there are a number of ways that you can get back into fixed income. We think it is a generational opportunity. Some investors have never seen yields this high in their investing careers, if you think about investors who are newer to the market. So playing the short end is a good, safe way to do it. You have things like shorter term T-bills and treasury floaters that are yielding over 4.5%. We do see investors actually going into the long end, however, which is very interesting. So just year to date, we've taken in $22 billion. Most of that is actually in our treasury suite. And what's interesting about that is investors seem to be diversifying their bets. So a lot of that's on the front end, but it's also on the back end as well, which is something I think might surprise people, just given the fact that the Fed hasn't signaled that they're done.
Right. So, I mean, with that in mind, we're not exactly sure if we're getting to have a pause, perhaps another rate hike higher than the 25 basis points. Still a lot of uncertainty there. So then where's the smart place when it comes to bond ETFs for people who want to get in, take advantage of these yields, but really aren't sure how to approach it?
I think the shorter end still makes a lot of sense. I mentioned the treasury floaters. That's a great way to get yield while minimizing your duration risk at the same time. So for an investor who really hasn't settled on a view, that's a nice way to do it, because then you're able to earn some income. You're not taking a lot of interest rate risk in the process.
And obviously, we've seen a lot of global stress, especially on the banking sector. How much is that affecting how people are investing, where the flows are going?
Well, the volatility obviously has really spiked because of the banking episode. We saw Treasury volatility hit levels that it hasn't hit since the financial crisis. And I think in response, what you saw was a surge in volumes of Treasury ETF trading. So we saw volumes, I want to say, 3 times the normal average for Treasury ETFs. Our entire suite saw elevated volumes. And for us, that is something that we see a lot with bond ETFs. Whenever there are stressed markets, investors actually tend to pivot towards those products because of their liquidity. They're easy to trade. And so it wasn't surprising to see treasuries get that much interest as a result of all this volatility.
And so for people taking a longer term view, then obviously at some point we're expecting a Fed pause and a pivot. How should they adjust their portfolio to sort of account for that as well?
At that point, I think investors will start allocating in a more traditional way. So they'll start buying broad multi-sector fixed income, which allocates to treasuries, to investment grade, to mortgages, things like that. They'll want to be diversified versus what they're holding in the equity part of their portfolio. And they probably will want to not concentrate their positions in any one sector. So I would expect them to shift from the short end of the curve further out and then broaden out their allocations.
And what do you see as potential risks to these bond ETFs?
I think bond ETFs hold bonds, and so you have to think of them very much in the same way you would view bond risk. So are you worried about interest rates going up? Or are you worried about credit? The bond ETF itself has tremendous utility in terms of trading and being able to move efficiently in markets. So again, typically in these stress periods, while the underlying market may run into challenges liquidity-wise, almost every single time we see bond ETF volumes accelerate very, very sharply. So that in and of itself has tremendous value for investors who are trying to navigate the market.
And what's your take on international exposure to bonds at the moment? Obviously, still sort of seeing what's happening with China, with Europe as well. How are you seeing that landscape?
So we, up to this point, we have not seen a huge amount of flows going back into, for example, emerging markets. We're starting to see some of that happening, but it's a little bit choppy. I do think investors, once they have a view on where the Fed is going and what their sort of landing place is, I do think you'll start seeing, I mentioned diversifying allocations. That will include international and EM as well.
Well, certainly a lot to keep hold of. Fixed income, still the play right now, especially with a lot of volatility. We don't know how long it's going to last. A pleasure having you there. BlackRock Global Co-Head of Fixed Income ETFs, Steve Lapley. Great to have you with us in studio. right, let's get you a market check here, sponsored by Tasty Trade. Still seeing all three major indices in the green here. The Dow picking up a little bit of steam there, up about 180 points right now. The S&P also still bolstered there, but just up slightly, about 36 points. And the tech-heavy Nasdaq enjoying some gains there, up over 1% on the day. All right, coming up, Lyft announced an executive shakeup earlier this week. We're joined by the incoming CEO right after this break. Stay tuned. Electric vehicle maker Lucid navigating a rocky road as it plans to lay off roughly 18% of its workforce as it looks to preserve cash and cut expenses. Lucid expects to complete the workforce reduction by the end of the second quarter as the company looks to continue making steps towards managing costs. And while Lucid sticks to its cost discipline, Warren Buffett-backed EV manufacturer BYD posted a record number of electric vehicle sales as net income soared over 400%. The Chinese EV manufacturer's performance turns up the heat with competition with Tesla for market share. However, Tesla's moves to slash prices in China appear not to have been enough to gain the competitive edge in the cutthroat Chinese market. Well, Polestar is making its move to take on the established U.S. luxury market with its electric crossover SUV, the Polestar 3. Here to discuss with the details is Yahoo Finance's Pras Subramanian. Hey, Pras.
I know you're a big fan of the electric SUVs these days, so I had the chance to see the Polestar 3 in the flesh. They bring in the road show for the car in the U.S. They want to show it off to customers and even investors here to show them what's next with the company. I think it's their biggest release so far this year in that highly competitive EV market. So it's coming next year, but it'll be built in China. But then starting in 2024, it'll be built in South Carolina at the Volvo plant there. And what will happen is that although the car right now costs more than the $80,000 IRA tax credit, I spoke to CEO Thomas Ingenlath about a cheaper version on the way. Here's what he had to say.
The Polestar 3 as an SUV will, when we introduce as well the rear-wheel drive and the version that is not connected to all the luxury package immediately, will as well qualify for the tax reduction that customers then can have. Having said that, purchase to release program from day one will enable the customer to enjoy the tax relief.
So what he's saying at the end there is that actually with the commercial lease exemption in the IRA, customers now will actually be able to use that tax credit at the time being for now for leasing, but not purchases. So anyway, a big 2022 for the company last year. They actually had a gross profit one of the quarters, believe it or not. And 2023, going to be no less important with that Polestar 3 and also just sort of the new kind of continuation of the Polestar 2 sales. Here's what Thomas had to say about this year coming up.
23, then opposite to 22, obviously will be a year that is much more connected to consumer demand, since thank God, supply chain and all of that is a little less of a burden than it was the years before. So a little bit more of normalization in the automotive market.
So some normalization there for them, but then also still a big year for them with the Polestar 4, a sportier SUV coming out later this year.
I'll keep an eye on that. You know, I do like a sporty EV. Always good to have you, Pras Subramanian. Thank you so much. Well, staying with autos, the battle for the rideshare market is as hot as ever, and Uber's big competitor has a new CEO leading the charge. We're joined by Lyft's incoming Chief Executive Officer, David Risher, and our very own Brian Sozzi as well. A pleasure to have you on the show, David. So, I mean, investors are really going to be looking to see where you're taking the company next. What are going to be your top priorities when you take the helm in April?
So great to see you, Rochelle. Great to see you, Brian. Listen, our top priority is getting a great experience to our customers. I mean, to a certain extent, it's a focus on the basics. Make sure we pick you up on time. Make sure when you open our app, we're priced in line with the other guys, and get you where you want to go. And you know what? Rideshare is a big deal. It's really improved people's lives in so many ways. And I'm kind of okay with your calling it, the battle is back, because we're ready to fight and hopefully do pretty well.
David, Brian here. Good to see you here, and congrats on this appointment here. Now, you've been on this Lyft board, so you are familiar with the company. What has gotten Lyft to this point, and what do you need to course correct?
I think the thing is we got to focus. We have to really focus on rideshare and our customers and our drivers. In a way, it's very simple. The more passengers and riders you have, the more drivers want to drive. The more drivers want to drive, the faster your pickup time. So as long as we're doing a really good job on those basics, that's going to get, us part of the way there. And then, of course, there are questions that I know you're going to want to ask about where we're going to go in the future. I probably won't be able to say too much about that just yet, but we've got a lot of big plans already brewing.
And I know you said, now is going to be that time for that battle. We know you don't want to really compete with Uber in its existing services. So what would the plan be if you're not going to compete in those same spaces?
Well, I mean, look at what Uber's doing. So Uber has decided, I think their business model depends on being able to deliver, pizzas and, tuna sandwiches and packages and all kinds of other things. The problem that I see with that is, as a rider, I'm just not that excited about getting in the car with the tuna sandwich. And as a driver, the idea of double parking, outside the restaurant and getting a ticket, and then it's just a different thing, and not getting paid as much, by the way, as you do for rideshare. So I think to a certain extent, this is still a very young market. We're still talking about fractions of people, and by the way, fractions of activity because of COVID. And I think over time, as more people get out, as more people come back together, there's a lot of room for both of us. And I think if we stay focused on rideshare, we're going to do really well.
David, your first 90 days in, how will you immerse yourself in the business? Are you going to be, we've talked to John Zimmer a lot in recent years. He's been driving these cars. I mean, he says, look, I'm out there driving these cars. I'm connected with drivers. Do you plan to do the same, and have you done the same?
Yeah, I haven't yet. I did get my car inspected this past weekend. Good news, it passed. And I also passed the background check. So, I'm well on my way. But look, that's one of the great things about John is he's been so passionate about making sure he really kind of understands the details of the business. I'll be doing that. I'll be, of course, meeting with employees, as you do. Been talking a lot to investors and to the press to make sure people understand that Lyft is back and the customers have a real choice right now. And, and I almost hate to bring this up proactively, but I'll do it. Look, efficiency is also in the air. And so we've got to focus on doing the absolute most important thing so that our drivers and our riders get the best possible experience at a price that's in line with what the competition offers.
On efficiencies, David, now Lyft has been very aggressive in cutting expenses. Do you see more opportunities to do that? And then secondarily, some data out this morning on the sell side saying some trends in your business have started to stabilize towards the end of the quarter. Anything you can share there?
Can't really share there. I think you kind of understand why. But I will say that for the last 15 years, 14 years, I've been running an organization that has to solve big problems, in this case around literacy for world reader, but with very, very small budgets. And so I'm very, very comfortable with the idea that, honestly, sometimes you can sort of get twice the team, without twice the people. So we're doing a lot of work there to try to figure out how to get our costs as good as they can be.
And I know you do a lot of focus on the customer experience. And during the pandemic, you had a lot of people working from home. At this point, still expecting some sort of long-term hybrid work experience. How will you then grow the company from here if that is going to be the longer-term trend?
Yeah, it's interesting. Of course, there are going to be hybrid work environments. There's no question. That's the new reality. But I would say, if anything, I'm feeling a bigger push to say, you know what, let's get people back out of the house and back to work. And that's not just sort of a philosophical thing. It's a practical thing. Decisions can be made faster. Mentoring happens more. At a time where consumers are under so much financial pressure, companies like us have to work really hard to make sure we're providing the best value. And frankly, a lot of the time that happens with people together in front of a whiteboard. So, I sort of think, it's a mistake to think that we're going to be cloistered in the future. And not that you said that, but I actually think over time, more and more people will want to get out and back together. That's where the magic happens.
To drive that magic, you need drivers, David. Do you have that access to the labor pool that you need?
We do. Driver supply is always an issue. The truth of the matter is, if you pay well, and we for sure have to focus on that, drivers tend to come. It's interesting. I had a great ride with a driver in Atlanta, and he said, what I love about driving for Lyft is I'm never going to go broke. I'm never going to go broke. I just have to drive. And same with the guy here in San Francisco, Luis, great guy. He said, look, in construction, I made $600 a week, and that was the top. I couldn't go above that. There just wasn't more work than that at my level. But I can drive as much as I want. And then in 2 weeks, I have the control to be able to go to a bachelor party. So I think for drivers, actually, there's a lot of upside for them still.
And so how do you plan on perhaps streamlining some of these costs while also improving pricing power, not just for the drivers, but also for the customers as well?
Yeah, that's my challenge, but I'm up for that, right? And I think, people think in trade-offs sometimes, but I think this is one where you don't get to choose. You both have to be price competitive. You have to be priced in line with where the other guys are, and you got to deliver a great service. And that's just, like so many businesses, you just have to figure that out. And we're very focused on making a profitable company long-term. So that's my challenge.
David, what do you think the end game is here for Lyft? Is it part of another brand, another company, another tech player?
Look, we always look at options like that, and people approach us from time to time. But right now, our focus is on creating such a great service that in whatever configuration, we're going to be relevant, valuable, either as a standalone company or something else. Look, remember, too, you guys just ran a segment on electric vehicles, which, of course, leads to autonomous. As autonomous vehicles happen and you start to see, interesting experiences within rideshare where maybe it's not a driver in the front seat, but a barista, all sorts of fun things can happen, or a karaoke bar, I don't know. But if you sort of look way, way out, rideshare networks like this, like ours, are going to be really, really valuable.
Certainly a long play there indeed, but we're excited to see what happens here. Lyft's incoming Chief Executive Officer, David Risher, and our very own Brian Sozzi. Thank you for joining me this morning.
Great to see both of you guys. Thanks for the talk.
All right, coming up, U.S. pending home sales rose for the third consecutive month. We're joined by an expert to break down the current state of the housing market. Stay tuned. Pending home sales rose for the third consecutive month, up 0.8% from January. For a deeper dive into the real estate sector, we welcome in Odetta Cushy, First American Deputy Chief Economist. Great to have you on the show, Odetta. So first, I want to get your reaction to this data and really the state of the housing market at the moment.
Absolutely. It's great to be here. I mean, the numbers beat consensus expectations. The expectation was that pending home sales would fall this month. And that's really because we had a month where rates went from 6% to 7% by the end of February. So the 0.8% is a modest gain, but it's the third month of increases, and it comes alongside increases in things like builder sentiment, mortgage applications. So it's a very soft start to the spring home buying season, which is a very crucial time for the housing industry. So we're off to sort of a soft start, but a lot of demand out there. The issue is really the volatility for mortgage rates and the lack of supply.
So you say this is a slow start, then what is the outlook from here?
It really is dependent on mortgage rates. This is a very interest rate sensitive sector. Right now, mortgage rates are down a little bit, and so that should help to coax some buyers off the sidelines, really help with affordability. But then, of course, you can't buy what's not for sale. And so inventory is just so low that, we might actually see a bit of an increase in prices because those who are shopping around might be stuck in a bidding war.
And as they like to say, real estate is local. So talk some of the markets here that are seeing some of the sharpest changes.
So the West Coast, in particular, sort of the more traditionally expensive markets, San Jose, LA, San Francisco, we're starting to see double-digit price declines in those markets from the peak. Whereas markets in, the Midwest or even, the Florida, South Florida, Miami, prices are fairly resilient. They're still very high. The pending home sales from today showed that, there was regional increases in pending home sales in all regions except the West. So again, this traditionally more expensive markets are really the ones that are bearing the brunt of this affordability crunch and sort of the decline in the housing market.
So put this in context for us in terms of how it fares versus 2008, because a lot of people say, housing bubble, but are you seeing that as well?
No, this time it's different, or maybe I should say last time it's different. This is a fundamentally different housing market. We don't have, these loose lending standards, subprime mortgages. The fundamentals were really the driver of the house price acceleration over the pandemic. It was an increase in demand and against very, very limited supply. That was the result of that was house price appreciation. That was not the case last time around. It was driven by speculative, lending practices and fix and flip buyers. And we're not seeing that, consumers that were buying homes are in a much better position.
And what do you think are some of the risks that perhaps some people aren't really pricing in at the moment when it comes to the housing market?
Well, the risk right now is if we have a job loss recession. Right now, we're seeing price declines, pretty broad-based price declines. Obviously, some places are more resilient than others. But if you have those price declines alongside job losses, that's really when we're at risk for distress or foreclosures. You really need both. People have an inability to pay their mortgage and also underwater on their properties to have the outcome of foreclosure. And right now, the job market is very strong, so we're not worried about it at the moment. But if that starts to happen, that's really where I would be concerned.
And obviously this is happening amid a banking crisis that seems to at least be stifled for the moment. But we're looking at what might happen in the future in terms of tighter lending conditions. We know that people have been watching the commercial real estate market. And what about the residential market as well?
It's a little too soon to tell. I do think we'll probably have some tightening in residential real estate, not to the extent that we'll see on the commercial real estate side. It's interesting because there's sort of this housing benefit from the banking bust because mortgage rates sort of came down. There was all of this uncertainty, investors sort of flocked to the safety of U.S. Treasury bonds and mortgage rates declined. And so you get this affordability benefit from lower mortgage rates, but then of course the potential for credit tightening could negatively impact the spring home buying season.
And obviously this is a snapshot. What else should we be looking at in terms of direction for where the housing market goes from here?
So, obviously mortgage rates are the big thing, but recession risk, uncertainty is really the other side. And I think coming back to demographics, there's all this demand out there. The problem in the housing market's not demand. There are plenty of buyers on the sideline. There's a massive generation of millennials that are aging into their prime home buying years, and they're sort of waiting for the market to be more affordable so that they can jump in. So I think from a long-term fundamental perspective, you have this demographic tailwind, and really the question mark is what will happen with mortgage rates going forward.
And even as we look at things like affordability and also availability, when we look at what's happening with construction trends as well, how much more difficult is that going to make the picture?
That is the question. Inventory. The inventory is so low from a historic standpoint right now. Existing homeowners are staying put. 93% of existing homeowners are locked into mortgage rates below 6%. And so in this environment of higher mortgage rates, they don't have an incentive to leave that low mortgage rate. And so they're not selling their homes. There's sort of this seller's strike in the housing market. And the majority of home inventory is existing home inventory. So if they're not selling, there's nothing out there. Builders are sort of picking up the slack. So they're sort of gaining market share when it comes to inventory. So if you can't find an existing home for sale, it's possible that you might find a new home for sale because that inventory has been increasing.
And in terms of how builders are changing, because some of that I've been speaking to who used to do some of these big luxury homes are now looking at sort of more affordable townhouses, trying to really adapt to these market conditions. What are you seeing at the luxury end versus sort of the lower end of the housing market?
It's still really hard to build for that first-time home buyer. You know, the number of projects that are priced below $300,000, which would be where that first-time home buyer is very, very limited. It's just not profitable for builders to build at that price point, but certainly that's a price point they need to be thinking about because there's this huge demographic of potential first-time home buyers that are looking in those price ranges.
And as you mentioned, they're waiting on the sidelines.
They're waiting, exactly.
We'll have to see what they do. Great having you on. Odetta Kushi there, first American Deputy Chief Economist. Thank you for your time this morning. All right, coming up, Kevin O'Leary, aka Mr. Wonderful, joins us live after the break. We'll talk all things from the fallout of Silicon Valley Bank to the current state of the crypto market. You won't want to miss it. As regulators continue to gather the facts behind the failure of Silicon Valley Bank, some politicians are blaming former President Donald Trump for rolling back regulations during his administration. Let's break down what we know so far with Yahoo Finance's Rick Newman. Good to see you, Rick.
Hey. This is now getting a lot of scrutiny. This kind of slipped below the radar back in 2018 and 2019. But a couple of things, important things happened back then. Trump was a huge fan of deregulation. I mean, he ran on that. He said he was going to roll back some of the Dodd-Frank reforms, and he actually pushed for that. Congress did change some of those rules. They loosened them on medium-sized banks, which happened to include the two that recently failed. And then another important thing that happened was the Federal Reserve and other banking regulators actually eased the way they supervise smaller banks. And all of this is now coming back into the system. And we just had this testimony yesterday from some bank regulators, Congress trying to figure out what went on. So it's never one thing when you have a blow up like this. I mean, it's usually a bunch of different factors coming together in ways nobody foresaw. And I think that's the story with Silicon Valley Bank and the other one, Signature. But this is all going to be thoroughly reviewed now. And it seems quite possible that we're going to undo some of that banking regulation from 2018 and 2019 and redo it again. By the way, Trump is a candidate for president in 2024. If this were a normal election, he should explain what he thinks about the impact, the consequences of the policies that he pushed when he was actually president. Nobody's asking him about that. He goes to his rallies and he talks about witch hunts and rigged elections and stuff like that. If we get to substance, this would be a good thing to ask President Trump.
Because one thing that some of the lawmakers were questioning on, was there good enough use of the regulations already on the books versus the need to expand? How do you see them really sort of walking that line?
So first important thing is the bankers screwed up. I mean, they completely mismanaged the interest rate risk, and nothing about regulation should get them off the hook. But the Fed itself has now said, they were the main regulator, the Federal Reserve, and they noticed problems at Silicon Valley Bank going all the way back to the end of 2001, related to interest rate risk and did they have enough liquidity in a stress scenario. All kinds of things apparently went wrong, such as the stress test they put the bank under was to test what would happen if interest rates went really low, but not if interest rates went really high. So it was the wrong stress test. Why was it the wrong stress test? Many times in 2022, Fed regulators identified problems at Silicon Valley Bank, but they never actually did anything about it. One of the changes that happened in 2019 was when bank regulators detect problems, they no longer had to report those problems to the board of directors of the bank. They only had to report those problems to members of the executive team. So that would, if the CEO and the bank managers wanted to keep that from the board, they could potentially do that. That may have been an issue here. So the banking regulators saw the problems and they just were unable to stop the failure of the bank. So what the heck happened? I mean, we don't really know, but that's what we need to find out.
Certainly, and I believe we'll be getting more details when both the FDIC and the Fed release their full reports on May 1st.
Yeah, and I'm not sure those are going to be definitive because the Fed is basically going to be investigating itself. The FDIC will be investigating itself, and I think this does call for some kind of third-party outside answer.
Indeed, lawmakers certainly not happy with what they've heard so far.
Not so far.
Rick Newman, always great to have you on.
Thanks, Rochelle.
All right, well, a sense of stability has returned to the markets as fears over a looming banking crisis begin to ease and as bank regulation now remains top of mind for US lawmakers. Meanwhile, the crypto industry is going on the offensive and some speculate that the White House is trying to push it out altogether. Let's bring in O'Leary Ventures Chairman Kevin O'Leary, also known as Mr. Wonderful, for his take on all things bank and crypto. Wonderful to have you in studio here. So first I want to get your take because I know when you were first hearing about sort of the FDIC taking off these guardrails, you were like, look, what's the point of investing in some of these bank stocks? What's your take now, especially in what you're hearing from these hearings?
I think the question every American taxpayer has to answer individually is, do you want to guarantee every tiny bank in America? Because you're being asked to do that. It's great when politicians say, oh, don't worry, the taxpayer is not paying. Let me explain exactly why you, the taxpayer, are paying. FDIC insurance is paid by banks. The banks get that money by charging you fees in your account. You paid for all of it. And so now, just to count the record here on Silicon Valley Bank, that cost you as a taxpayer $20 billion, 16% of the FDIC insurance pool. It's gone. So you can only do that 10 more times and there's nothing left. And so why do we need 5,000 banks? What do we need that for? That's a great question. Now, if you like the idea of riding your horse up to a bank branch 100 years ago, that's great. Or maybe you say that it's unique to the economy of a singular state, and you have to have a unique banker to take care of an agrarian society, or maybe a tech society, and or economy in California. But we don't need that anymore because 97% of bank transactions are done online.
Right.
So we need an oligopoly of well-regulated, imputedly guaranteed, because the law says 250. And so that's the narrative. If you take a poll in this building, whoever's walking around here, and say, do you want to guarantee the next bank in California with your own money that's going to zero because it has idiot management? I think you'll find 9 out of 10 people say no. We're going to go through a metamorphosis. We're going to see a consolidation of all these tiny little banks into super regionals. Maybe we get down to a couple of hundred banks in America, but I personally, as a taxpayer, have no interest in guaranteeing the next idiot management. Don't want to do that.
But then what does that do for lending conditions and for customers as well if we do have this sort of compression?
Nothing. The whole point is it might have made sense to have these regionals when you needed that touch pace, where you said, oh, I know every family in this geography, in this city, and I'm a banker, and I support the local baseball team. Nobody cares about that anymore because they do everything, including getting their credit card online. Over 97%. That is an old kumbaya, warm and fuzzy feeling of America in the 40s and 50s. That's not what we are today. We are a very competitive online banking community that has to basically bear the cost of compliance. All of these new rules are going to be imputed now as a result of these investigations will make most of these banks unprofitable. I would argue that bank stocks themselves are just a trade. They're not good investments. These are going to become highly regulated utilities. And it's the only sector of the 11 sectors of the S&P 500 that services the other 10. So it's simply a utility. Let's get over it. Let's regulate it and stop kumbayaing about all these tiny banks that are going to zero for sure.
But Kevin, you do have some people who perhaps aren't as tech savvy, who aren't into digital banking, the unbanked. Some of those people perhaps more interested in something like a crypto or some other sort of function. So you're saying that we really don't need these regional banks anymore?
I heard that argument pre-pandemic in 2021 when everybody was locked in their condos. Oh, grandmothers, what are they going to do? They can't go shopping anymore at the local grocery store. They got hip to their cell phones. They went online and they ordered their groceries, or they starved to death. Choose one. The same thing with banking. Everybody has their app on their phone and banks that way now, whether you're corporate, whether you're individual. Let's have a moment of silence for small regional banks. They're dead. It's over.
Well, with that in mind, then, obviously we're still sort of passing out the blame, and I guess we'll hear a little bit more from some of these regulators on May 1st. But I do want to shift gears and talk crypto. Obviously, the CFTC now cracking down on Binance. A lot of people thought perhaps Binance would be okay after FTX's collapse. But people had an eye, though, on what CZ was doing. How worried should we be about this, not just for the crypto industry, but who's going to be the next platform that's really going to draw the ire?
I think the story that's emerging as of yesterday morning when these charges were laid is an incredible Greek tragedy. And I'll tell you why I look at it this way. The two pioneers that created this nascent industry and made it global, Sam Bankman-Fried and CZ. Then they went to war against each other, just like in Greek mythology. And one of them won. CZ definitely bankrupted Sam Bankman-Fried by using the FTT token in the last stroke on that November 6th, $550 million right into his heart, and he had to, declare bankruptcy. Then, of course, all the allegations and all the charges. And now he's victorious, but only for a few weeks.
Right.
Because whammo, the regulators come after him, and this is why it's a death knell for Binance. Just follow these dots, and there's a great investment opportunity emerging here. So now you're Binance, you're a global leader, but you've got the American regulator charging you. And that means every other regulator wakes up around the world that has to do business in the United States. So let's say you're a sovereign wealth fund in Norway, in Abu Dhabi, in Saudi Arabia, or any country where you want to put $250 million to work a day. Those are the kind of numbers. Goes through the depository in New York into the S&P 500.
Right.
You have to remain compliant with the SEC. The SEC and other regulators in the US have just said, this company is not compliant in our jurisdiction. what are you going to do? You're going to say, listen, CZ, love you, honey, but I don't think we can give you a license here to resolve this thing in the United States. And then the US regulator says, and this is where it gets really interesting, and this is the really Greek mythology part of it, even though Sam has been wiped out by this, the reason he had to buy CZ out was to get CZ off his balance sheet because CZ wouldn't disclose who owns his company. Highly speculated to be the Chinese government. Now the US regulator is going to say, okay, pay us the $8 billion fine or whatever they're going to impute, but disclose your cap table. And if he has to do that, either he won't or we'll find out the Chinese own him, in which case he'll never get an American license. I think it's game over, checkmate for CZ, and it's only a matter of time till there's a run on that BNB token, $64 billion. Now, either the Chinese government is backing that token or they're not. But if there's a run on that, it's sayonara CZ. Then here's the investment opportunity, and I've got my guys doing this everywhere. Find me in every jurisdiction where Binance is operating supposedly under a compliant license, and find me the number 2 regulated environment, the number 2 regulated exchange. Let me invest in that. Because when CZ sails off into the sunset back to China, I want to invest in that. Starting in Canada, France, Switzerland, Abu Dhabi, wherever it is. We're watching the end of a great Greek tragedy. The 2 guys, the founders, they killed each other. It's fantastic. This is a wonderful Harvard case. I'm going to teach it.
It makes for good TV, but not so good for retail investors sort of stuck in the middle. I do want to ask...
You've got to get your money out of Binance El Pronto. Are you kidding? I mean, the U.S. regulator just hit him with charges 24 hours ago. Did you see the evidence? Unbelievable. I don't know how he's going to get around it. Look, a moment of silence for Binance.
But before I let you go, I do want to get some of your previews for Q2. A lot of people looking for investment opportunities in the upcoming quarter. Where are you putting your cash to work?
About a third of it, we had a real challenge with all the regional banks because we had to take it all out of there. Because I have 54 portfolio companies. I called my CEOs and said, look, how much did you get? How much was in Silicon Valley Bank? That we dodged a bullet there. What else do you have? Do you have anything in First Republic? Get it the hell out of there. Any regional bank, get it out of there. Choose the 4 money center banks for now. I want all of the money I invested in you in those 4 money center banks. I am not the only person that did this. So we pulled a lot of cash out of these regionals or investment dealer brokers, and we're rolling T-bills right now in 90 days. And this is happening all over America. This is why I'm telling you, there's a death knell to small regional banks, because no matter what you say or what Yellen says or what the president says, you can feel good about a regional bank. Okay, you feel good about it. I'm taking my money out of it for now while we work all this stuff out. On the crypto side, I think it's going to be a renaissance. I think the opportunity to invest, because all of these compliant exchanges, take the Canadians, they made no money because Sam Bankman-Fried and FTX and Binance, they operated with impunity with no cost of compliance.
And just so we're clear, are you talking tokens or the exchanges or perhaps underlying
everything?
Blockchain?
Dealer brokers or broker-dealers are tied to an exchange that had to be compliant, bore millions of compliant costs in each of their geographies. And, Binance didn't have to pay any compliance. And that was great while you could do that. But now you've got every regulator on earth saying, whoa, the US just said this is not a compliant platform. And as a result, I think that puts a lot of pressure on everybody to say, well, where's the next compliant one? Because you know what's amazing? I'm going to make a speculation here that I think I'd love to go back forward 5 years. All the players that are not in harmony with their regulators now, that were the founders of the crypto industry, they're all going to be swept aside. And a new generation of crypto banker will emerge just like old bankers used to be, totally compliant. It's that old Who song, won't get fooled again. Are you going to put your money in a non-compliant crypto exchange that is it at war with its regulator? I don't think so. And this is good for crypto. This is the next stage in making it something real that you can invest in. I'm giddy with excitement. I think you can tell that. I'm energized today. I knew this was going to happen.
Yeah.
And I think it's wonderful that now, hopefully, my investment thesis about buying into all of these regulated exchanges, which has done nothing for me for the last 4 years, all of a sudden everybody's waking up saying, okay, what do I buy in Abu Dhabi? What do I buy in Canada? What do I buy in France?
Because a lot of people are still waiting for the use cases here, and it may seem like the long game, but interesting. We'll be keeping an eye on what happens with this next generation of crypto
Last
leaders.
thought, use case. My best performing asset in the last 4 months, Bitcoin. Where do I hold it? On a Canadian exchange.
Interesting.
That's compliant with the OSC order. Yes, I think there's a great use opportunity for crypto.
As long as you stay
I'm
compliant.
I'm excited.
I couldn't tell, Kevin. O'Leary Ventures Chairman Kevin O'Leary, thank you for joining us this morning. All right, we've got more in store for you later today in our 3 to 5 show. U.S. pending home sales were on the rise for a third straight month in February, hinting that the housing market may be steadying after a shaky year. Realtor.com chief economist Danielle Hale joins at 3 p.m. for a deeper dive into that data. And Starbucks former CEO Howard Schultz currently testifying on Capitol Hill, the former exec facing questions from lawmakers about alleged union busting at the coffee chain. We'll break that down for you with the latest this afternoon. All right, well, before we go, let's get you a final check of the markets as we head into the noon hour. We're still seeing all three in the green at the moment. The Dow there leading the charge there. We're seeing that buying action picking up more than 230 points right now. The S&P, all 11 sectors in the green, up 42 points. Tech-heavy Nasdaq, they're also off to the races, up about 155 points on the day. Well, that'll do it for now. I'm Rochelle Akufa. I'll be back with you at 11 a.m. Eastern. See you then.